Good morning, Saturday, April 23, or good afternoon, Michael Howell. Michael Howell is no stranger to this room. We're very fortunate that Michael has 30 minutes he can give us today. Michael is well known, having started his career at Salomon Brothers back in the 80s, having worked with Henry Kaufman, Laszlo Barini, etc., etc. He really needs no introduction. He's a good friend, known him for decades. He's been in this room on multiple occasions. He is, as I keep repeating, and I have no affiliation with Michael. I say this because I really mean it. I just try to share the wisdom that I've accumulated over the ages from people like Michael. He is the preeminent expert on liquidity in the world. And I think one always has to pay attention to liquidity. Stan Druckenmiller famously once says that people spend too much time worrying about earnings and fundamentals and not enough about liquidity. And liquidity is a funny amorphous thing. It's like trying to get hold of a wet fish. You just are trying to grab a shadow. And Michael does as good a job as anybody, or the best job of anyone, in trying to quantify liquidity and what changes in liquidity mean for asset markets. And I've had the privilege of knowing Michael for over 3 decades now. He's made some brilliant calls. I'm going to tweet out later. He sent me the chart, and Michael made in his Twitter feed this morning a reference to it looks like Japan. Just asked George Noble. And so that probably would be a good place for Michael to start his remarks. But I think we're going through a regime change here. The tectonic plates of the financial landscape are shifting. Michael signaled this going back last fall. So he's not one of these talking heads who just jumped on the bandwagon and said, "Oh, it's going down, it's going down." Yeah, no shit, Sherlock. He was sounding the alarms last fall. And it's not that he was right. It's that he was right for the right reasons. And it's the type of conversation, the types of things you need to talk about that you're never going to hear in the mainstream media. And so Michael's looking at, and it kind of annoys me at times. He does annoy me because he makes me think. And it's the kind of guy you got to listen to 5 times to get what he's saying. He'll say things like, I don't really look at valuations. I just care about the quantity of money, how it's being invested. And that probably offends the sensitivities of most of us in this room. It's like, what do you mean you don't care about PE ratios? Well, I've learned the hard way over the years to pay attention to Michael, which is why I shamelessly sing his praises in Twitter. So, Michael, I'm not going to go any further because I know you're limited with your time. And with that buildup, sorry to sorry to put you in a tough place, but I really mean it with all sincerity. And thank you all for coming to this room. I think this is going to be one of the most important rooms of the entire year. So, Michael, with that, the floor is yours.
Good. Hi, everybody. Thanks, George. What an introduction. I don't know if I can beat that, but let me let me sort of step up to the bar and see if I can say something about these markets. I think the main thing is that liquidity is what drives financial markets in many dimensions, and investment managers and investors generally have got to get a handle on really what the liquidity backdrop is. Where is the money and where is it going? Where is the world money? Where is the global money? And what direction is it taking? And I think if you step back and you go back 10 years or a little bit more to the GFC in 2008, one of the things that really came out clearly there was the Federal Reserve had lost control of the US dollar credit system. And basically, one of the results was that the system derailed. There was just too much credit growth. We saw what happened. Basically, there was excess in the system, and that excess ended in a significant financial crisis. Ever since that date, the Federal Reserve, in particular, has basically muscled forward and got control back of the system. And if you try and quantify that, on our estimation, the Federal Reserve has got something like 3 times the muscle power today that it had in 2008. And that's something that you've really got to remember, because the Fed now has got the bit between its teeth and it's seeking to get rid of inflation. And what it means is there's going to be a significant tightening out there. And I think you can see some of the corollaries of that already, because the dollar wrecking ball is starting. And that is swinging, and it's already taken out the yen. It's putting a lot of pressure on the Chinese yuan. Sterling's had a difficult week, and the euro may be next in the firing line. So what we're going to see here are the just joining the dots. Now, let me say a little bit about what is liquidity? Why is it important? What are the things that we're watching, and what's the outcome? In terms of liquidity, what do we mean? As George says, it's a kind of slippery concept. It's not money supply. Money supply is an archaic definition of the liabilities of retail banks. Liquidity is nothing like that. Liquidity really starts where traditional money supply measures basically end. And what we mean by liquidity is the ability to change one's positioning, particularly in asset markets. And that depends a lot on wholesale money flows, and the sort of things that we're watching are things like Federal Reserve or central banks in general, how much liquidity they put into the system. We look at what the banks and the shadow banks doing, particularly in the wholesale markets, and we look at cross-border flows. And that total of liquidity is something like globally about 175, 180 trillion dollars, and benchmark that against world GDP, which is under 100 billion. So it's a big number. This means a lot, and it's got high velocity. So what we're looking at and we're tracking on a monthly basis are these flows. Now, why does it matter? It matters because initially these flows basically drive forex, fixed income, and later equity markets, and later still the real economy. And what you've seen already, particularly in the fixed income markets, are the very, very clear signs that liquidity is creating a problem. And the two things that I would cite is to look through a lot of the conventional narrative about the yield curve inverting or whatever. And some people say, does it matter? Yes. Does it matter? No. There's a range of opinion. What really matters in terms of looking at the term structure, particularly in the US Treasury market, which is the key market worldwide, is to look at a decomposition of the term structure in terms of two halves. And that's what we used to do at Salomon Brothers. And that was absolutely key to understanding it. The traders instinctively had this view. What you would look at is the front end of the curve, say the 1 to 3 year. And that's telling you the steepness, and the strong steepness of that curve is telling you that rates are going to punch up significantly in the US. The Fed means business, is getting aggressive. Bullard's floated 75 bips at the next meeting. It's pretty much nailed on. You're going to get 50, I think, given what Powell's already saying. So this is the first of many rate hikes. And the next thing to say is, if the front end is steepening, what's happening to the back end? We'll look at the 5-10 spread. Okay. Now you'll see that the traditional 10-2 straddles these two areas of the curve, and it gives a distorted message. You've got to look at the yield curve or the term structure in terms of two halves. The second half is giving a really ominous message. And what you're getting is a significant flattening at the back end of the curve. So, in other words, tens are trading below fives. And what that's telling you is that risk appetite of investors is collapsing. They're basically seeking out safe assets in the system, which is the sort of the 10-year bond, the 10-year note rather, in the US, the Treasury note. That's the key safe asset that everyone gravitates to it when there's problems. Now you're seeing that happening. So you've got two things going on simultaneously. The front end of the curve is steepening fast. It's saying that the cost of financing, particularly around the 3 to 5 year area, is skyrocketing, particularly for corporates who issue in that space. It's a problem. And secondly, the appetite for any risky debt is collapsing. So it's going to be really hard to get corporate issuance away. And look how much in a number of markets corporate issuance has just completely dried up. It's a really difficult market. That is the beginnings of big problems in financial markets, other financial markets, and in the real economies. A recession, I think, is pretty much nailed on. I don't think it's going to be a bad recession, but it will be a recession, and the markets are not discounting that. The key fact is that the Fed really matters here. The Fed has got a lot of muscle, and it's basically taking liquidity out of the system. Look on our Twitter feed, which is Cross Border Cap. That's the handle, and you'll see a lot of charts we put up which correlate the movement of Fed liquidity injections with the markets. It's almost one for one, and has been over the last 3 or 4 years. What they're doing now is they're clearly taking money out, and last week was a big drop in terms of the effective liquidity injections that the Fed has been putting into markets, and that's why you're getting really difficult closes on Wall Street. It's going to get worse than this. Now, I drew the parallel today, as this feels to me a lot like Japan in 1989. And George is the expert, so let's defer to George in a moment. But I remember I was there, and one of the things that spooked everybody was that Mieno, who was the Powell equivalent, the head of the Bank of Japan, basically said in the middle of 1989 we're going to kill inflation. And everyone said, well, hey, well, there's no inflation really in Japan. What are you going to kill? And he said, we're going to kill service sector inflation. And everyone scrambled around and said, well, we've never seen, no one's got an index of service sector inflation. What's he talking about? But that was really the beginnings of a very significant tightening by the Bank of Japan that went on for years and propelled the yen a lot higher. Now, the question that we've got to ask here is this going to happen to the dollar? Now, the dollar looks expensive, but that doesn't mean to say it's going to go down. It may get a lot more expensive. And if you're getting a significant tightening in the US, you've got turmoil in Europe, you've got uncertainty in Asia, you're going to get a lot of money coming into the dollar as safe haven, in my view. And basically, the dollar could move a lot from here. That's putting pressure on the yen. And maybe there's a subtle agenda here, who knows? And maybe the Treasury is trying to shake the tree and put pressure on China. And that, if that is the tactic, it's kind of working because the Chinese yuan has had the worst week it's had all year. It's starting to weaken significantly. And if you get a weak yuan in China, the Chinese are going to have to do something because they've been targeting the currency for the last 5 years. They'll break their stability, their notional stability pact on the currency. And that could be very, very serious. So, in other words, what I'm saying, and let me maybe stop after this and see if people have got questions or George has got comments. What you tend to find in financial markets is kind of like what we used to call in Salomon Brothers a law of conservation of volatility. You get volatility in one market area, say the fixed income markets, it migrates into the bond markets, and then it ends up in the equity markets. And we're seeing that kind of movement going on right now. There's been a lot of bond market vol. You've seen pickup in currency vol, and now equities are in the sights. And that's what I would be very wary of. The last comment I'll make is that we've been saying, look, if you get a straightforward monetary tightening, the market's down 15%. If you're throwing a recession, it's 30% down. And if you get banking crisis on top, it's 50% down. Now, my bet is we're in the middle of that. We're basically we're recession plus monetary tightening. So I think the market's down 30. So that means another 20 from here.
Michael, thank you for that cogent tour de force. A few questions. I know you have a hard stop in 16 minutes at 4:30 your time, 11:30 our time. If there aren't any questions, please. I see Shrub, Tommy Thornton, Jeff Carbaz, Jeff, whoever wants to ask a question. We have limited. Michael has limited time here. So, Michael, coming back on a couple of points that you raised, you think you're going to take the middle. The middle scenario that we've got maybe another 15 or 20% down in markets. For the individual investor, what would you be telling him to do? I mean, is cash as an active asset allocation decision actually U.S. dollar cash? Is that what you would be telling people to do?
Yeah, I think US dollar cash makes sense. I think that you want to be at the front end of the term structure. That to me makes sense. I mean, it may even be worth taking a little bit of a punt as a barbell strategy of looking further out. Maybe start to look at something like a 10-year. I mean, just put your toe in the water. But I think that there's a possibility if we get recession that you could be seeing a significant rally at the long end of the market. And there's no major institution that I can think of anywhere worldwide that's currently overweight fixed income.
So, Michael, it's watch what people do, not what they say. One of the things that's really got me hot and bothered lately is the misuse of sentiment data in FinTwit.
Right.
To invoke that quote from Walter Deemer, something to the effect, "It's not when people turn bearish that counts; it's when they're done selling." And if
Right.
you look, we've just now had two back-to-back weeks. We've had 2 weeks of significant outflows. Shrub was in the room as the expert on this stuff. I think there was 13.8 billion the week before, and 20 billion through the week to Wednesday, taken out of U.S. Equity funds, if I'm not mistaken. But that comes on the back of, and the statistics are somewhat subject to debate because double counting or whatever. But on the official statistics, there was more than $1 trillion that went into U.S. equities in 2021. So if you look at, and I know you're not a fan of sentiment, but if you look at positioning, could you
Mm-hmm.
please speak to, because you had some really brilliant charts. I remember a couple of days ago, you showed relative to the money stock and positioning you were trying to like extrapolate, where things should go. So as far as positioning goes, do you think the positioning is still all wrong?
Yeah, I think that I think if you look at positioning, I mean, you're absolutely right to say what's been going on here is that a lot of investors have been shifting out of fixed income. Now, even if they have not been redeploying that into stocks, and there is evidence that some of it has been redeployed to stocks, the fact is that the asset allocation with that declining bond position is becoming uh, you know uh, more skewed towards risk because the equity portion has stayed pretty much intact, let's say, fixed incomes come down. So essentially, people implicitly are taking more risk in that equation. They've taken bonds to be the risky asset when actually equities are. Now, if you look at our position, we do positioning data for about 25 markets worldwide. And if you look at the positioning data, and let me just sweep across the world, if you look at the one market where positioning looks okay, in other words, investors have got a lot of safe assets and not many risk assets, ironically, is China right now. But then China's had a bear market for a year to actually get into this zone. So China looks okay. The US is above average, but it's not anything like as above average as other markets. So in other words, the risk positioning is above normal, but it's not that extreme. Where you've got extremes are in mainland Europe, so the eurozone area, which actually, bizarrely has gone up ever since the Ukraine invasion, which is mystifying. But that's what's happened. And then if you look at emerging Asia, there's also quite a lot of very high risk positioning. So those are the areas that we think are most vulnerable. But then again, you've got if you go within sectors, I mean things like tech, long duration areas are really going to get nobbled as well. So I'd be really careful about some of these areas. So your favorite stock ARK has probably got
There you
further
go.
down.
All right, so I have one more question for now, and then I want to go to John Roque. One of the things I found particularly noteworthy that wasn't the focus of attention for investors. I mean, everyone's who wants to jump out the window. They see the indices going down, but I really know I note with interest what's been happening to bond yields and the dollar and the oil price despite all this. I mean, bond yields, a 10-year U.S. Treasury yield was hardly down. I think it was close to 290 yesterday or something like that. The dollar made an all-time made a new local high. The oil price was down. What's more interesting was the action in the oil stocks that got destroyed. But normally the relief valve when you have risk off, you'd expect bonds to rally, yields to fall. That hasn't been happening. In fact, it's quite the opposite. There's a reason it's happening because the whole reason the market's going down is because yields are going up, and I suspect we're in the midst of the throes of regime change. So, do you just like it wasn't just Japan went down. We go back to 1990, the Wayback Machine. We were going through a regime shift, and you and I have talked a lot about the specter of possibly sustainably higher inflation, et cetera, et cetera. But the question really is, and I accuse myself, others of rambling, but there is a question here. Um, the fact that you have huge risk off, but bonds don't really go up at all. I mean, to me, that's telling you all you need to know. And I think equities have been given a death sentence. I mean, how would you respond to that?
Well, if what you're saying is the outturn, you're absolutely right, because that's really what matters for equity valuations in the medium term. I mean, one of the reasons that I would still say, from a secular point of view, I'm still relatively upbeat on stocks, is the fact that I think the bond yields will come back again to sort of around, let's say, 2.5%. That's what I would envision. And the reason I say that is that I don't think inflation is an embedded problem as far as I can see. And the reason for that is that my view about what drives inflation is that inflation is less of a monetary phenomenon and much more of a real economy phenomenon. And you've got a very different dynamic in Western economies now with aging populations. And that's really the key factor that will cause inflation or likely cause inflation to come down in the medium term. But that is then, now is now, and I think the issue to find out or to ask is why is it that the fixed income markets are not rallying when you'd expect so? I think part of the reason is that people are not discounting, a recession. They'll rally hard when that recession comes. The beginnings of that process is underway, and the reason I say that is just look at term premia, which you can proxy by this 10-year minus 5-year spread. Term premia absolutely collapsing. in the US Treasury market. And that's telling you that nobody wants risk. Now, if it were not for the fact that rate expectations were going up at the same time, what you'd see is a strong rally in the bond markets already. So you need those rate expectations to stop going up to enable the US Treasury market to rally. And I think that my view is that, latest expectations, I think, is terminal Fed funds at about 3.25 or thereabouts as of last night, or circa that level. That's probably as far as they can get. I mean, I'd be surprised if the Fed manages to get that far, because there's so much debt out there that the system is just very fragile. And as I keep saying, this system is a refinancing system, not a new financing system. You've got to roll over 300 trillion of debt every year. You've got 300 trillion of debt, which is 60 trillion every year. And that's a lot of balance sheet and liquidity needs there. So, in my view, the Fed is going to be lucky to get rates up as much as the market's thinking so far.
All right, I just one last question, and then I'm going to go to John, because you just said something that piqued, touched one of my hot buttons. I've been saying for months now, and I've been advocating. I was taking the over on oil and rates and the whole bit. I've been saying for months, one of the reasons I believe that, just forget about the inflation for a second. That's sort of Captain Obvious, page one, first order thinking, was the idea that balance sheets in the corporate and consumer areas are much stronger than they were in the last cycle. So you had people say, oh, all the hysterical hand wringing. Oh, look at what happened in 2018. They want to take 50 billion a month, and they only could do so many rate increases or whatever, and they had to stop. The whole thing's going to break. Yes, they're going to keep raising rates until somebody breaks. I get that. But the question I have for you is, like, what's the strike price on that? I.e., and maybe this is outside your purview, but given the balance sheets in the corporate and consumer area are much better shape than were in the last cycle, what does that say about possibly the ability of the real economy to withstand higher rates more readily than would have been the case 3 or 4 years ago? So people who are taking their cue from 2018, yeah, history doesn't repeat, but it rhymes, and they may be reaching the wrong conclusion. I.e., I don't think there's a single person in this room except for John Roque who's been calling for 3% rates for months now. Maybe there were some others around, but nobody came out of the closet. I've been calling for higher rates. Roque's been calling for higher rates. It surprised everybody, I think probably even John and myself, that we've gotten here as quickly as we have. So you have to ask yourself, why is this happening? Is it an overreaction? Is it negative convexity? Blah, blah, blah. So 2 questions. A, what do you think of the ability of the economy to withstand higher rates more readily than the talking heads would have you believe? And therefore, the strike price at which we're going to have this refinancing crisis may not happen. Let's say the 10-year goes to 3.5 or 4.
Yeah.
And we
No,
don't have a
I hear
blow,
you.
and we don't have a blow up. And if that happens, then do I hear $20 on ARC? So what would you say about that?
Yeah, I think that's clearly a possibility that the real economy is more robust. I don't think financial markets are as robust, and that's why I think the problem is, and that's where you're going to see the tension. So I hear what you say. It's possible. On the other hand, to play devil's advocate, if you look at a lot of leading indicators, so you look at some of the future expectations that came out of the Michigan survey, that came out of the Philadelphia Fed survey, came out of the New York Empire State survey, the future expectations are basically all being crushed. So it looks as if the average business and the average consumer is not looking at the future very positively, and that cannot be good. The second thing is that the distribution of balance sheet health may be highly skewed. So the averages may hide quite a lot. And if you look at what the United Nations publish an index of world food prices, that index has doubled, so 100% up since the beginning of 2020. That's going to hit a lot of low-income families right across the world, in Europe, in the US, and in Africa, Asia, etc. So this is a meaningful factor. And if they're spending on food, they're not spending on other stuff. So that's another issue. So I would tend to look at that. But I hear what you say. Maybe the real economy comes out of this better. It means that the Fed can keep going for longer, or will have to keep going for longer, in theory. But whether the financial markets can take it is an entirely different matter.
Yeah, and I agree. I take your point 100%. And then whether for the nuance on the nuance, say we get the slowdown, But last I checked, the Fed's not able to produce more oil or grow more wheat. So what if we get slowing growth and the inflation data, okay, maybe it's peaked, but it comes down at an agonizingly slow pace. And to the extent that it's viewed as a political liability right now, because the poll ratings for Biden are very low, okay, they get the slower growth. But if the target of their affection or disaffection is inflation, then they've got a devil's choice between tightening further into a big economic slowdown, or trying to kill inflation. So, I mean, how would you say if they're faced with that dilemma that maybe we get a slowdown, but inflation doesn't come down as quickly as they would desire? What would you say to that?
Well, I think that the choice they're making from listening to the changing rhetoric of central bank speeches, not just in the US but also in Europe too, is that they're starting to warn the public that this may be recessionary. The Bank of England did that on Friday of last week. So let's just listen out for the Fed governors in the next couple of weeks ahead of the next FOMC and see if they start cushioning the market or consumers to say, look, we may be getting closer to recession here. In other words, what that's telling us is they've got the bit between their teeth and they're going to go and kill inflation. I mean, I think that on paper we're looking at one of the sharpest tightenings that we've seen for a long, long, long time, and it's akin to what. That's why I go back to Japan. It's akin to what Mieno did in Japan. He really slammed the brakes on, and everyone said this is crazy. He's not going to persist. It's going to take the break off soon. He didn't. And how long did that go on for, George? I mean, that was 3, 4 years.
And Michael, more importantly, again, if we're worried about our bank accounts, that was one hell of a bear market. I mean, the S&P. Look, we can get into composition, all that nonsense, fine, but markets, in my view, have a hell of a long way to fall right here. And I've been continually describing equity markets as representing return-free risk, and I still maintain that position. All right, you only have, and so John Roque is up to speak. John's a big basketball fan, so John, I'm giving you the 2-minute warning. 2 minutes left to go in the game.
Oh, thanks, George. Michael, thanks very much. It was great getting the education while you were speaking. I have two questions for you. Each of the 14 prior rate rise cycles have caused some financial calamity and something to break. We're in the 15th rate rise cycle. Is it going to, in your opinion, break first in the currency market? Is it going to break in the sovereign debt market? Or is it going to break in equities?
Well, I think from the I would say traditionally in terms of what the central bankers think of, they don't really care that much about stocks. We'll see whether this particular Federal Reserve Board takes it more seriously. So I think you've got to start looking at the sovereign debt markets, the corporate debt markets, which has been the one thing that's always spooked the Federal Reserve. That's what they've normally that's what's caused them to blink, is when you get serious problems in US corporate debt, because the corporate debt market is a major financing vehicle in the US. As you know, it's much less in other markets. So that's the key thing that they watch. I'd be looking at those spreads to see how much they balloon out, and I think there's a real risk of that happening. So I'd be looking there. As regards the dollar, that's the other area that I think is something to watch very closely. And I must say, I've been sort of lukewarm about the dollar for a while now, because the last decade has seen a perfect storm of capital inflow into the US, which has pushed the dollar above its fair value. And while I accept that, the question is there's got to be some mean reversion. But what we're into now is a new game, and the Federal Reserve's sudden alacrity with which it's tightening, and the scale of its potential tightening, is going to make every other economy blink. The Europeans are dithering. The Japanese don't want to tighten. The Chinese, well, maybe they're out of it in a way, but they would find it hard to tighten more, I think, now. So if the Federal Reserve does it, it really pushes the dollar up, and it causes a lot of problems in international markets, as far as I can see, because all these other guys will start having to chase the Fed, and that's going to cause a global catastrophe. And then the Fed's got to start to think about, what do we do here? Who do we allocate our dollars to? Now that might be, and this is sounding terribly Machiavellian and maybe completely off the script, but is this what they're trying to do? Is this part of their capital war against China and against Russia and Iran, etc.? Is it what they're trying to say is that we're going to try and push the dollar up, create a crisis, and then all these other countries are going to come begging for dollars because they need dollars for their financial system. And we can ration in the idea of our swap lines between friend and foe. Now, who knows? Who knows?
Okay, Michael, I have a second question. I promised George I'm going to get it in under the shot clock. Here goes. Dollar yen is at a 20-year high. I think something has to give. And dollar China, as you noted early in your intro, has moved sharply higher. How can we have at the same time yen devaluation and yuan devaluation? Thank you very much, George. Thanks, Michael. Thanks. I'm going to turn off now. Thank you.
Okay. Well, I think the one of the things to take a look at is, I mean, this is I'm gonna go slightly over my 30-minute allocation, but one of the things to take a look at is what the Asian currencies have been doing over the last 5 to 6 years. Back in 2016, there was a deal that Bloomberg or Reuters basically publicized, which was called the Shanghai Accord. It wasn't public, but it was basically a sort of an agreement, a shadow agreement among the G20 to try and take some of what was then upward momentum out of the dollar. And out of that, you see tremendous stability in the Asian currency units against each other, but also against the major crosses. And that was really being led by the Chinese. Now, if you look at a basket of Asian currencies over that last 5 or 6 year period, there is virtually no volatility in that basket at all. They've de facto created an Asian euro. Now that may well be a problem in itself because I guess the idea was that they were going to start to move closer to the Chinese yuan in that process, and maybe the whole idea of this is to try and break that link. I just don't know. But one of the things that to come back to this explicit question, what you can see is what you've seen as a big devaluation of the yen against the US dollar, and by implication with the yuan held against the dollar until last week, you were seeing basically a big devaluation of the yen against the yuan, which is uncomfortable for China. And that may be the factor that's really putting a lot of pressure on China. It's a little bit less, or we'd say it's equally the yuan dollar cross, but it's also the yuan yen cross that matters to them. And that, I think, is going to cause them either to tighten. We'll see if they do that. They haven't done it yet, and we look at China on a daily basis. There's no evidence that they're throwing the towel in and tightening, or they let the yuan devalue further, and maybe it goes up to 7. That's a distinct possibility. I think with the yen or the Japanese markets, what I think they've got to do is to allow the long bond to start moving up now. And I think that in a way, you're beginning to see the ability for them to do that because inflation looks as if it's getting some traction in Japan, and that would be the excuse they need. But basically, rates everywhere, I think, are starting to move up. There is a big monetary tightening going on here, and it's being led by the Fed. And the Fed has a lot more muscle than it had 12 years ago in 2008.
So, Michael, you've been very generous with your time. I really appreciate it. So, I guess this to sum that all up again, to make it relevant and actionable for the average investor in the room, you're suggesting that sort of a defensive posture is warranted. Continue to argue for that. Is that fair?
Yeah, exactly. I mean, what I'd be looking at, I mean, this is the investment zone that we call turbulence in our strategy work. Basically, liquidity conditions are below average and falling, and in that environment, what you want is basically defensive stocks. You want things like branded names. You want more utilities, that kind of thing. You don't want to be in the tech space or anything which is long duration. You want to have US dollar cash. And you want to be, at the front end of the yield curve, but beginning to nibble at the back end.
Got it. Thank you, Michael. It was really great on a sort of hastily arranged ad hoc basis. Really appreciate it. Always, I hope you'll keep coming back to this room and keep tweeting. You've helped so many investors, so that's fantastic. So have a great time with the better half, and hope to hear from you again soon.
Great.
Be well, Michael.
Thanks.
Be well.
Thanks for facilitating.
That's great.
George.
That's great.
George. Well done,
All
George.
right.
Thank you.
Thank you. Thank you. All right, so let's go to some questions now. We've got a couple of folks coming up on stage, and I see a lot of friends in the room as well. Shrub, if you want to weigh in on the weekly fund flows data, that'd be great. Please raise your hand. I see Mark Newman is there. So here we go. So Shrub, since we're talking about liquidity and flows, I can't think of any better to speak on this because you watch the flow data like a hawk. Maybe you could elaborate on what you were seeing, and also from where you sit, because you've had a very, you and I have looked at markets in a pretty similar vein. Your reaction to Michael's comments and how you're thinking about the world. Thank you, Shrub.
Yeah, hi George. Thank you very much again for doing this. So look, first of all, your spaces have been invaluable both to me and for I think a lot of investors out there, because we've been brainstorming about this for the last 3 months. So I think when you brainstorm on something, you're ready when it happens. So for the last 3 months, I was coming in and I was saying, oh, you know, inflows. What the hell is going on? What is going on? And then suddenly last week, we had the first big outflow. And then this week, we had 19 billion of outflows. And that's the largest outflow we've had in a week since February 2018. So it's very significant. And, it goes back to Walter Deemer's quote that, people have to almost print and put on their table. That people have to sell when they have to. So this is like, I posted a picture of an iceberg because this is how people should be thinking about this. You've had Mike Green before, and he's a very smart guy, and I really respect him. And he's been going on about passive strategies. And the way we should think about this is we had $1 trillion coming in the market in the last, since COVID. And we've only had 30 billion of outflows last couple of weeks, 30, 40 billion. So you should think about it like the tip of an iceberg, unless it turns. And this is the scary part because valuations can be exaggerated on the way up, but they can be exaggerated on the way down. So if I was an equity bull in the tech space, what I would be really scared right now is I would be looking at Facebook trading at 12 times earnings. And then I would be looking at all the shit that ARK has that has no earnings or very high multiples. And I would be really scared because if Facebook can trade at 12 times earnings, then all these other stocks should be trading at below 20 times earnings too. So again, the passive flows, they exaggerate on the way up, but they exaggerate on the way down as well. So this is something to bear in mind. Like I said, the outflows, to your point as well about credit, because credit has been having consistent outflows. The one area you remember actually for me and you, where I raised the red flag on the positioning was when credit kept having outflows every single week. And I said, when does credit impact equities? When is the tail that wags the dog? When does credit actually impact the equity? Wake up the equities, and that was the big red flag. And then on Friday we had a big risk-off day, and bonds didn't do anything. So there's still really not a bid for bonds, and I'm getting tempted to buy. Michael said it that you have to start thinking about buying bonds, but there's a big problem here. With which I identified with my smartest macro friend that runs a big fund. And he mentioned something that no one is really talking about. If you go and study the bank results, the major bank results, US bank results, he noticed that the US banks haven't bought any treasuries the last quarter. And I think this is really, really important. And he's actually concerned. He was raising it as a major concern because the major buyers of treasuries are China, and China has its own problems. And also there's a geopolitical aspect to it, which I think is maybe China is going to question any strong purchases. And the second one is US banks, and they haven't bought any bonds. And there's many reasons for that. One reason is they took a hit on their book value because their existing bond portfolios took a hit this quarter. And the second thing is they don't know where it bottoms. So why would you as a bank go and allocate capital, especially when you can buy the front end? You can buy the front end and make as much as you can do in the long end. So why take the duration risk? So that's...
Sure. Yeah, Shrub, 100% on that point. I'm glad you brought that up. I mean, let's just go a little deeper on that. So you have had the foreigners who used to be huge buyers of the U.S. bond market basically not buying. You have this flow data. I just know they're not big buyers. I can't remember if they're small
Yeah, they're
buyers or
small
small
buyers. Yeah.
sellers. But okay, they're small buyers. So I went from being big buyers to small buyers. You have the ongoing price insensitive forced buyers, the sort of liability matching guys, and Michael Howell has talked about that in past rooms. To meet obligations, people buy bonds no matter what. They immunize their bond portfolios. That's fine. Okay, forget about them. But you have two sources of buying power, three actually: the foreigners, the banks themselves, and now if the Fed walks the walk, doesn't just talk the talk, they're going to go from buying bonds to selling bonds. Okay. Okay. So imagine. Okay. So Shrub, do you want? So I started the sentence. Do you want to complete it?
So look, this is the problem. I mean, I was having this discussion with the guy, and it's like, well, China's out, the U.S. banks are out. The U.S. Treasury thinks they're gonna tighten by $1 trillion or $2 trillion. So who's gonna be buying it?
It's a Shrub, Shrub, they're
I mean, we're laughing, but it's the biggest market in the world, and
I
people are
know.
fucking around trying to call the bottom on like stupid tech stocks.
I don't know, Shrub. Why are we finding this so funny? I don't understand. Whatever. I mean, you know what? Just stop right there. Because I want Mark Newman to weigh in because he has an opinion on this, and he usually can see things that I can't see. So, Mark, are you there? Mark Newman, can you weigh in?
Hi. Hey, George.
Yeah.
But George, you got to promise not to be triggered by things I say this week. All right.
I promise, Mark. I promise.
So I'll circle back to some of the other things, and I'll hit the current topic right here. So there is some group, some swath of investors that probably has to be an indiscriminate buyer of bonds at some point. Maybe it's the pension guys, maybe it's the insurers, but they have to. That could be a source. I'm not saying, look, you guys pointed out a ton of selling pressure. I'm saying one buyer could be that indiscriminate bond buyer who has no choice in the portfolio balance world to buy. I'm just saying that's, inflows into pension funds, bond funds, insurance like funds types. Those are the ones who are indiscriminate buyers, have no choice. Is it enough to offset the deluge? Well, maybe not. I don't know. But George, I will say we remember, like, as soon as things looked sort of most dire in the rates world, like with the problem of backdrops in Japan that we saw, rates would inevitably stop and reverse. Now, I think we're in a different market structure here, so I don't know that really applies. But that's my point on the bonds. I had some other things I wanted to chat on, but there are some indiscriminate bond buyers who are forced buyers.
Yeah. No, Mark. No, that's right. I think we talked about it. The problem is the size of that pool. Listen, the indiscriminate guys, like, they're not price sensitive. Just because the price is, okay, so the price has gone down, they'll buy some more because they can immunize more of their portfolio, but not a lot more. And so the thing is, like, Mark, I mean, you're a trader, you've been in markets for years. If you know there's a ton of supply coming, you kind of fade the bid a little bit. And so to me, people can talk about growth. This is where I think the disconnect is. People talk about growth, but the real issue is inflation. And yes, growth will correlate sometimes more, sometimes less with inflation. But if the target of affection of the Fed is inflation, and let's just say hypothetically, it's things like it's things like extractive industries, like energy, it's food. The Fed can't fix that, and so you could have a slowdown where, as opposed to other scenarios where where inflation was a much more demand problem, this is a supply side problem. So you could get just because you get slowing growth doesn't mean you're going to get that slowdown in inflation the way people say. So
George, there's not a ton of defense for stagflation. There just isn't.
Right. Okay, but let me take it one step further. And then once you say, okay, well, so whatever inflation is going to be, so let's say economy slows down, inflation comes down some, whatever. We're then coming out of an environment where you've had real rates at absurdly low levels. So part of this move has just been about the normalization of real interest rates. And so I just, everyone likes to try out these equity risk premium charts and trying to justify that stocks are cheap relative to like the lowest interest rates you've ever seen in history. Well, look how that calculus has changed in the last few months just because rates have gone through the roof. Forget about the fact earnings estimates are now in the process of rolling over. And I would invite Michael Kantrowitz to come up because he's very eloquent on this topic. So I don't know, Mark. I just keep coming back to equities represent return-free risk.
Totally. And look, I was talking about this the other day. S&P, I think the PE is around 21, 22-ish, whatever. Think about where the 10-year is now versus where SPY was back in 2018, right? We're back there, and I think the SPY was almost half of where it is roughly here. So there's massive expansion, right? The question is, if rates continue to be firm here, I asked someone this morning, are the days of single digit, like near the bottom, single digit PEs, is that gone for good? Is that gone for good?
And by the way, just going to liquidity, I can remember it's one of Peter Lynch's in-stock speeches. He talks about in the depth of the bear market back in 70, whatever the hell it was, 74, buying Taco Bell on one times earnings. One times earnings. And someone said, I don't know if it was Roke, and John, if you're listening, could you weigh in? Because I think it was you. Somebody said it, or Walter Deemer said it. I never have an original thought. I just repeat smart things I hear others say. Maybe it was Stan Weinstein. The hardest thing to do in a bull market is to stay invested. The hardest thing in a bear market is to stay out. And the reason for that is in a bear market, usually it's associated with, falling earnings. So the E is not what you think it is. So someone mentioned earlier, Facebook's on 12 times earnings. I kind of think it's probably not, but the E is wrong. But in any event, you've got falling earnings, and Michael K is going to talk in a second, but he just jumped out of here. Get back up here, Michael. So the E is too high. And on top of it, you're looking through the prism of backward-looking valuation. So someone says, well, Microsoft was on 40 times earnings. Now it's only on 30 times earnings. It's cheap. No. The thing is, Microsoft used to be on 20 times earnings. So, again, the hardest thing to do in a bull market is stay in. The hardest thing in a bear market is to stay out. So, Mark, why don't you just hang right there? I want to get some more comments from you. But I want to talk about cycles, and I can't think of anyone better than friend of the room, really smart guy. I don't know. I think the best strategist in the street. Again, I have no commercial relationship with him. He'll be embarrassed that I'm shilling for him this way, but I'm just speaking truth. Michael K., how are you, my friend? You've been a lot in this room. Love to hear your updated thoughts. What's going on, Michael?
Hey, George. Good morning. Totally agree with the prior speaker before Mr. Roke. The way we measure tightening and easing several different ways, and always draw conclusions where the breadth of evidence is. And when you look at the 5 basic drivers of the business cycle: short rates, long rates, the dollar, oil, gasoline, those are the variable costs that go up and slow us down and come down and help revive the economy. We created a composite of this years ago just to keep it simple, and we've gone from a record level of easing on those five different variables. I just tweeted this about 10 minutes ago. Going back to I think it goes back to the 80s, to a record level of tightening. So like what we see in the 10-year, it's the same thing as taken place essentially in the dollar. It's taken place in in global short rates have gone up, and the Fed's obviously going to add to that. Oil, gasoline, we know what that's doing, and the U.S. dollar is going up. It's just adding insult to injury on other economies that are going to respond from a tightening. So totally agree with that point. This is not going to end pretty, and I think what investors continue to miss. I keep hearing that the slowdown's already priced in, and bearish sentiment, AAII, is at really low levels. It should be, and it's probably going to stay there because there's really no economic catalyst to prevent this slowdown. We may get some good news if inflation slows or things in Russia, Ukraine stabilize more, and that could lift the PEs for the market in the near term. But the story here is, what's going to happen with inflation. But, we're going to add to that a continued sustained slowdown, looking at everything we're seeing now. And it's now happening. You're seeing small caps now, which had 2/3 of it positive of estimate revisions that were positive a year ago, and they were there steadily. Same thing with mid and large caps. Now it's down to 25% of small cap stocks seeing positive earnings revisions, and that's only going to get worse or stay that bad, and it's going to bleed into the rest of the market, and that's why I think you're seeing this continued defensive tilt in the markets.
So, Michael, I love the way you think about things. It was easy to call out the Cathie Wood type stocks months ago. That was the nail that was standing up that needed to be hammered down, and then it morphed into more general schmeicing of growth. But then we got into a discussion. I'd like for you to repeat the point. I thought it was an excellent observation. Your idea that you kind of wanted to be between the 30-yard lines. The idea that economically sensitive zombie dead value could also be problematic. So could you just speak a little bit about your view again on quality and like how you want to avoid both tails?
Yeah, sure. The best time for value is in an economic recovery. And I know, people, if you think about the world in a binary way, most people seem to be leaning into value because of the Cathie Wood stuff, which is, at the other extreme. But, we're certainly not in the beginning of an economic recovery where credit spreads are going to tighten and earnings estimates going to go up and sentiment's going to go from bearish to bullish. So this is a horrible time to own high-risk, deep value stocks. And on the flip side, take into account profitless, long-duration growth stocks that have no earnings. If the Fed's raising rates, that's also not a good backdrop for the other extreme of the style trade. And so, while there's been these big binary shifts that have been somewhat cyclical over the last 15 years from value to growth, and, it's value works, all value works, or all growth works, we've been kind of in the last year and a half or so pushing people more into the middle and almost more focusing on cyclicality versus defensive fundamentals or attributes, rather than saying it's time to buy value or growth. I think it's bad for both of those extremes, and we're seeing it at the factor levels, free cash flow yield, book yield, earnings yield, sales yield. When you look at it from a sector neutral perspective, they've all gone nowhere in 3 months from a value perspective. It's because defense is doing better.
So Michael, I'm going to tease you a little bit here. So what you're basically saying is no sex, drugs, or rock and roll. You want boring. You want stability, cash flows. You want good balance sheets. This is not a time to be a hero in either extreme. Is that what you're saying?
Exactly, and that's only going to intensify as more and more companies are going to get sucked into this global economic downturn. And like you said, until something breaks, tightening's not going to end. Oil, look at the periods where the economy was slowing and oil's going up. On average, the ISM gets below 50 before energy or oil prices finally crack on, the view that demand's going to collapse. We're nowhere near that. So
right.
We're still bullish. I know many are with the energy stocks and oil prices. I think, and with rates, additionally, you're going to need a deeper slowdown to get rates to come down than a typical slowdown where conditions start to slow, rates come down immediately. When the Fed's raising rates, you need a much deeper slowdown to get those rates down. So, I agree. Who knows how high they go? Maybe they stay here for a while, but when are they going to go down? You need a deep, deep slowdown, and that's coming, but it's not.
Yeah, Michael, help me for 1 second. I want to clarify something because you probably heard me talk earlier about how I keep taking the over on rates, but I want to understand why did you just say what you just said, which is you're going to need a deeper slowdown. That implies higher rates. Like, why are you saying we need a deeper slowdown? I'm not sure I understand you.
So when you look back at past cycles, there's two outcomes when you're at a peak in the profit cycle. If the Fed's not raising rates, and you're not in an inflationary backdrop, rates are going to follow economic momentum lower. Global PMI and the 10-year bond yield have a pretty tight relationship. The other scenario, which we saw in 2018, we saw it in 2004, we've actually seen it in every time the Fed's raised rates beyond a peak in economic momentum measured by the ISM index or the earnings revisions, rates stay high for a lot longer. Eventually, rates will come back down, The question is how deep, where's that Fed put, like you say, or how deep of a slowdown do we need to get the Fed to wake up and realize? And at the end of the day, everyone's so focused on inflation. Obviously, the central banks are appropriately focused on that. And we've seen leading indicators roll over. Coincident economic indicators like GDP and payrolls and profits are now starting to roll over. But lagging economic data, which is a lot of the data the Fed looks at, not just CPI, but other metrics, are not going to slow until later this year, early next year. So it's going to take a lot to change to get Powell to pivot. It's going to take a deeper slowdown for this to change. Like we saw in the end of 2018, right? Powell finally pivoted. That was after a full year of the slowdown.
So, Mark Newman, you still there, Mark?
Yeah. Hey, Jordan.
Yeah. Did you want to respond to anything Michael said, or you had some other thoughts you wanted to add?
Well, I did want to ask Michael the question, sort of in his, from record easing to record tightening. And I keep thinking about that old Jaws movie. You're going to need a bigger boat. Like desperate times, desperate measures. The fact that they've blown this bubble so long, now their response to it almost has to be orders of magnitude bigger than what we've seen in the past. So I wondered, Michael's thoughts on the record easing, record tightening shift. I mean, it's extreme, right? I did want to also mention one thing within this context of the sharpening rates, the raising rates, and Mr. Howell touched on it. He said he pondered, right? What was the U.S. ultimate plan? And when he was talking about the currencies, I just wanted to add one thing. We've talked about the dollar strength and how that can, go on in this environment. But when you look at the yen, the euro, and the dollar, if they're all going to eventually, race to debase, whatever, which of those three lasts the longest? And I think about it in that context because, look, global lines are being redrawn, right? And you have Russia, you have China. Who's siding with whom, backing whom in the end, right? And that's what I asked about Michael Howell's plan. What's the U.S. ultimate plan? Is there some element of you want your dollars? Come and get it. Or get in line, like one of those two things. And I think about that sort of the ubiquity of the dollar, the army backing the currency, right? Again, yen, euro, dollar. If Japan and let's say the Europeans were to line up and say, we got to go with the U.S. on this, they're behind the dollar, right? So that means I look at it like that, right? The army behind the currency when we talk about currencies. And also, back to Michael Kantrowitz, that sharp tightening, the record tightening, and the dollar strength that's befuddled everybody. Where, what's the glide path? That's sort of how I lead it. That's how I leave it. And I say the dollar is definitely going to be the last man standing between those other two I mentioned. Everything else, I'm not sure, and I don't know how it ends.
Michael, are you still there?
Yeah. I missed the beginning of that first question.
Okay. So let's just go on the way back. We missed the last 15 seconds of what you were saying. You said you wanted to wrap up, and we couldn't hear any of it. So maybe just go back to what you wanted to say.
I was just saying the next tightening that's set to come, and it happens every time the economy slows, you don't have to go into recession, is banks' lending standards.
Aha. Forgot about that one. Good point. Before we go to more questions, we're at the 1 hour mark. This has been a great room. We had Michael Howell for the first 35 minutes saying he, continues to suggest maintaining a very defensive posture towards markets, talking about how we're, got a long way to go in this liquidity unwind, and it's going to keep happening, keep tightening until something breaks. So Michael, as usual, he's nailed this, completely nailed this. I remember sitting in his office in London in October talking about this, and he had it completely laid it out. Before we go any further, I remind everyone, friends of this room know this. We do this for no financial benefit. Now here comes the squeeze. These rooms have been growing enormously. We're getting 20,000 people at a clip listening to these spaces. This is a first world problem that we have. Everyone has some net worth in this room that they're trying to maintain or increase. There are others in the world who are far less fortunate than we are. The room decided, or I decided with my group, and I have to call out Carol, Andrew, RJ, and Jack. There's a team of 5 of us that make these rooms happen. Carol is in charge of the philanthropic efforts of this room. We selected World Central Kitchen as the beneficiary of our efforts. If you find that there's being value generated in these rooms, I ask you to pay forward and give generously to World Central Kitchens. There's a link in my Twitter feed. I'll put it back up again. We've been able to raise $53,000 for the cause. I think we raised 8,000 in the last room and 12,000 in the room before that. Many of you who are up on stage have given generously. I'm not going to mention names. You know who you are. You're doing God's work. I do this for no financial gain. I'm going to happy to announce that we have a challenge that's been offered by one of the participants, as has been the case in the last couple of rooms. This person is anonymously challenging the rest of the room to a $2,000 pledge. This person it's matching. They're putting up $2,000. If to the rest of the room, we'll also together put up $2,000. So I don't think that's much of an ask. The information you're getting in this room would cost you literally hundreds of thousands of dollars. I mean, Michael Howell, Michael Kantrowitz, these are people that most of us don't have access to. And so to make a contribution to World Central Kitchens, to leave the world in a better place than you found it, I don't think it's much of an ask. So I'm going to put a link in my Twitter feed. I'll put an updated link. If everyone would please give generously to World Central Kitchens. I'm not going to end this room until the room costs up $2,000 because we have a matching pledge of $2,000. So that would be $4,000 for the good guys. Okay, so let's move on. I'm going to go to my dear friend Three Aces. And then after Three Aces, we're going to go to Rob. Three Aces, my friend, how are you?
Hey, guys. Hi, George. Nice to speak to you. I just wanted to make an observation, obviously, always in the form of a question, right? So, on one hand, we've got these gruesome sentiment numbers coming out of retail folks, consumer sentiment, and so on. On the other hand, in my limited experience in the 52 years I've been around on Earth, um, I always generally thought the real estate market led the stock market down by about 6 months or so. That may be inaccurate. But what we're seeing here in this just utter bloodshed in tech in particular, even biotech and some other things, I'm just curious as to what your take is. Have we even started to see the impact of the liquidity tightening, or is this just the world finally starting to wake up to holy shit, these stocks are just absolutely catastrophically overvalued? Because like Mike Green said just a night or two ago, the S&P is only down 7-8% or so. I'm just curious what your take is on that. Because on one hand, some of these things have been creamed so bad. On the other hand, I could see most of them going to zero, and that's your ARC, ISK, JDS Uniphase, Carvana crap that's out there. Thanks in advance.
Mark or Michael K or Shrub. Shrub, I really want to hear from you because you made the comment. I'll answer first, and I want you to answer, Shrub. So you were asking about asset prices and whatnot. I can tell you, I live in Westchester, just outside New York City, Westchester County. And for the first time now, this just happened basically overnight in the last week or two, the amount of real estate inventory is surging. I repeat, the amount of real estate inventory is surging. I also had a report, I'm not going to disclose location or name, but a very upscale suburb of a major Midwestern city. If he wants to come up and talk about it, he can. He knows the boy in the hood. He can talk about it, but I'm not going to give away sources. But he explained to me he has firsthand knowledge of virtually overnight the real estate market started to soften in that suburb. I've also gotten similar reports out of certain Florida locations. Now, we don't want to get caught up in anecdotes, but a pattern is starting to emerge, Three Aces. I think, and it varies by market. Maybe the Midwestern city is going to peak 3 months before Scarsdale peaks, before Florida peaks, who knows. But when you start to see inventory expanding, that's a sign, that's a tell. It may take a while for it to work through the snake, but that's a leading indicator. And Shrub, if you're still there, you had spoken already about a month ago how it was the Russians that were top ticking everything. And all of a sudden, I think your private banking friend said they're gone. And then the high-end restaurants are sucking wind. So, Shrub, can you give us a view from Europe? What's happening? What do you change at the margin the last couple of weeks? Because it's a change at the margin, which rings around Wall Street. What are you seeing and hearing from the European perspective, Shrub? And Shrub is in Monaco for those of you who don't know.
Yeah, hey George. So I think a month ago I told you about a property in a very high-end property in south of France, probably the most expensive area in the world. It was down 40% from the peak, and there still were no buyers. People always forget that real estate is a very emotional asset. If there's no value, and they always get greedy, they always keep it, and then the emotion kicks in, both on the way up, on the way down. These are properties that are in the tens of millions. So suddenly the repricing actually went from 16 to 13 to 9 million. Then since then, that was the first anecdote I told you. Since then, I've heard of very similar properties. And it's happening like the prices just are back like to the level of years ago. And then anecdotally, the yacht market here has just died. And I was speaking with a very big yacht broker, and he said that the transaction business is frozen. Obviously, we're talking about a very niche market, but it tells you about what the wealth is doing. But he said something that I thought was very interesting, that the chartering business is booming because people made a lot of money last year, so they chartered for this year. But he said it reminded him a lot of 2008, where the same thing happened. People made a lot of money in 2007. They booked their charters for 2008, and then the market just froze for 1 year. So he says he's got the same bad feeling. And this is a guy who doesn't follow the financial markets at all. He's just a yacht broker. But he just basically said, I see them, they're booking all the charters, and it just feels like it's the last big thing they're going to do before the slowdown.
George, let me add one point.
Yeah, Mark, go for it.
So my buddy moved to the West Coast, got a new job, and he's out there looking for houses. And he said all the deals, like Shrub speaks of the last gasp, all the deals are going through offer, all cash. And when I asked him, what about the financing? He goes, no, these are sort of the trust fund Silicon Valley type kids who can't touch their trust just yet. So they have no real access. So they pay cash. And like Michael K said earlier, the banks aren't doing the deals as much anymore. And this is that kind of evidence. So all these little anecdotes really add up to some of the bigger ticket things, seeing some funky stuff. And it really does smell a little bit last gasp effort. I just wanted to reiterate.
Couldn't agree with you more. And again, I don't want to get caught up in anecdotes, but it's like putting a puzzle together. We want to go to the bad boy from the hood, Detroit bad boy, my good friend. What's going on in your part of the world, Mr. Bad Boy?
Okay, I just wanted to kind of reiterate what George said. I'm in Florida right now. My parents are ailing. They're 91 years old, and we're in the process of getting rid of their assets that they can't use because they're in poor health. And they own a very nice home in Bloomfield Hills, Michigan, which is a suburb of Detroit. Now, most people think Detroit's a disaster, but trust me, Bloomfield Hills is one of the wealthiest suburbs in the country. It's in Oakland County. Most people are unaware of it. And when we were looking to put it on the market, I called some friends there, and they said, what you hear in every market in the United States. That is no inventory. Everyone's a cash buyer, multiple bids over the asking. This was 2 weeks ago. We put the house on the market on Monday. And on Thursday, the broker called us and said, you need to slash pricing. There's a barrage of inventory that just hit the market. The market literally changed overnight. So that was like out of left field. Because I'm in Florida right now, and it's still the mantra of no inventory, multiple bids over offer, everyone's a cash buyer, going up forever. Second point I'd make is I have a nephew that works at what I call a wise guy fast money hedge fund in Miami. They're very good. They do a lot of channel checks, but sophisticated, expensive channel checks where they pay enormous amounts of money for these data feeds that are proprietary. And he told me that they've been following the PayPal payment data for 10 years. And they've never seen such a steep decline so quickly than in the last 2 weeks. And the third and final point I'd like to make is they also pay a lot of money to get somehow proprietary data feeds on what's going on at Wayfair. I don't know why Wayfair in particular, but same thing. It's like someone hit a light switch. It just all of a sudden everything stopped. Business just rolled over hard. So I think my message is this: I'm not. I guess I'm shocked by how fast it's happening. It literally is changed in like a week and a half. So I got Friday morning. I got a little like it was a cold shock. I knew it was coming, but it hadn't shown up, and now it's showing up. So I just wanted to pass those anecdotes along. Thank you.
Hey, bad boy, appreciate it. Question for you. I think you're in Vero Beach or somewhere up on the east coast of Florida. Could you give some anecdotes? What's going up in your particular area on the real estate side? I know you were getting some heat. Or you were thinking about buying something, and I'm not sure I know what you did, but I'm sure you've been scouring the market pretty intensively in your local area. Could you tell us what's just going on in the Vero Beach area in terms of real estate?
It's out of control. As a matter of fact, I put in a bid on Friday with the market down 900, and I put in a conservative bid, and it went $1 million over asking. So they haven't gotten the memo. In Vero Beach down to Miami, it's off the charts hot. Now they claim it's because of the migration of people out of the Northeast and Upper Midwest to escape the tax man. But in my opinion, this is just all the same trade. I don't care if it's Scarsdale or Greenwich or Palm Beach or pick your nice place. I think it's all the same trade. But I didn't know the Scarsdale anecdote that inventories have surged until now. But
yeah, bad boy. Because you and I spoke yesterday, and the reason I didn't tell you that yesterday is because when you told me at Bloomfield Hills, I went to my better half and asked her. She's like, "Oh yeah, inventory's going up." I was like, "Wait a second, you didn't tell me that." So yeah, it's happening. However, pricing is still very firm. I mean, still going over ask. So I would say Vero Beach and Scarsdale are still on the same page. It's different from Bloomfield Hills. So you got, it happens slowly. It doesn't all happen at once. That would be my take on it. You got any thoughts?
Prices down here are up literally 50% from just last year, and I thought last year was out of control. So if they really start shrinking the Fed's balance sheet, everything goes. That's my belief. Maybe I'm wrong. Now, if they can slow down the credit creation and nothing happens, I'll admit I'm wrong. But common sense will tell you that what took it up is going to take it down. I mean, I think it's just that simple.
100%, or 100%, bad boy. I'm the same way. And just to remind people, Larry Gedelo, who's a friend of this room, has been in here before, and I said this a couple of weeks ago. I think I tweeted it out to remind everyone on the way up. The back of the napkin math, the back of the envelope calculation was each 100 billion of QE was worth 40 S&P points, or about 1% at current levels. And he thinks it'll be worth at least that much on the way down, probably more, just because the equity market's that much more or less liquid. But just using back of the envelope, if you just said 40, every 100 billion is 40 points, and they want to take the balance sheet down by 3 trillion, 30 times 40 is 1,200, which is a 30% off sale from present levels. So the interest here is not in trying to be precise. The interest here is getting direction. And as Michael K was saying, with the economy slowing, earnings estimates rolling over, valuation extended, people fully invested, like what could possibly go wrong? So again, equities, in my opinion, represent return-free risk. All right, let's go to Rob, and then we're going to go to KFAB. Hey, Rob, how you doing? Rob? All right. KFAB, you there?
I am, George.
KFAB, good to see you, my friend. What's up?
Always great to speak with you, George. I just wanted to add 2 more anecdotes to what Bad Boy had said. So Craig Fuller is a great follow on Twitter. He looks at transportation. And there's some other people through following him that I've started following. And the transportation area has hit a wall at the same time, kind of the last 3-4 weeks. And I have a teenage daughter for whom I'm trying to acquire her first vehicle for in anticipation of her first job this summer. And so I've been monitoring the car market and, again, following some people on Twitter that are very smart and involved. And it appears that seasonally, the kind of March, early April tax return time is like, the worst time usually to buy a car, because people get their tax returns and particularly used car dealers come in and just hammer people. And apparently that market died this year, meaning that they just completely did not get the type of flow of customers like they usually do and anticipate. And generally speaking, the used car market has really started to roll over, it seems, and the Manheim auto auction prices have started to roll over too. So again, just as a nexus of all of the things that have already been mentioned, and then I added up in the nest, Lakshman from Equity sent out a tweet yesterday. Their coincident index has actually, the growth rate of it has actually already went negative. So that's like looking out the window now. Is that, the economy has slowed enough already that the growth rate has turned negative.
KFAB, really, really insightful comments. And by the way, for those of you who haven't heard him speak before, can't recommend following KFAB strongly enough. We have some really smart people in this room. That's what makes this room great. I'm just the organizer. But it's people like KFAB, Three Aces, Michael K, Detroit Bad Boy, Shrub. They make this room. And I thank all of you. And together we're trying to figure this out. We're just a bunch of ordinary guys trying to figure this out one at a time. We don't know the answers. We make a lot of mistakes, unlike the fakers and the posers on CNBC and these other FinTwit rooms. We have the best content, period. I said to my colleagues the other day in an organizational meeting, we are the Saudi Arabia of content. We beat everyone on content. We also have the best rooms because we have the best people in these rooms. And not everybody likes the way I moderate. Well, we use a Socratic method. We keep it on the straight and narrow. I know I got kind of hot the other day, but there was some fellow who was just running on at the mouth, and it was just like ridiculous. It was wasting everybody's time. At any rate, we now have Shrub help me. I'm a technology Neanderthal. I keep screwing it up, trying to put things up in the nest. If you look up in the nest, the link to World Central Kitchen is up there. Please give generously. As I said, there are people who are, literally being bombed on. I mean, World Central Kitchens is doing God's work. There are other organizations that should remain nameless that you are aware of that won't even go into the Ukraine because they get bombed on. Well, guess what? World Central Kitchen got bombed on. I mean, these people are literally taking their life in their hands. So here it is. We're all sitting here on a Saturday morning, in North America or Monaco, wherever it is, drinking our coffee and just shooting the breeze with each other. I urge everyone, I beseech everyone, I implore everyone, please, please, please give generously. Leave the world a better place than you found it. So it's the least we can do. I see we're up to 54,000. If we get another $1,200, that'll give us 2,000 on the day, and then the match kicks in for 2,000. And by the way, just as a reminder, preview coming attractions, on Monday we're having Chris Verone, who is the head of macro and technical research at Strategas. He's a wonderful thinker, wonderful chartist, at 4 p.m. And then on next Thursday, John Roque and I will be doing the keynote address at the CMT conference being held in Washington, D.C. It's at 3:30 p.m. There will be a free live stream of this event on our YouTube channel. To attend this event, you either have to be a member, or if you're not, you got to pay big money. But this will be given free, free access. It'll also be recorded if you can't watch it live. But John Roque and I will be tag teaming the CMT keynote address. It's Thursday at 3:30 p.m. Okay, so again, please give generously to World Central Kitchen. The link is up in the nest. All right, let's go now. Shrub, did you have something you wanted to say, Shrub?
George, just to mention that Christine, who's a good friend in this room, so she pledged $2,000 to meet the goal. So thank you very much, Christine. She's a great person and very, very knowledgeable oil and gas expert.
Oh wow! She just pledged $2,000. That's phenomenal.
Yeah.
Awesome.
So thank Christine. Really appreciate it. I think everyone does.
Yeah. If she feels so inclined enough, she's in the room. She wants to come up and talk about. She got some opinions about oil and gas. We should talk about energy.
Yeah, she's here. I mean, Christine, she used to run an oil rig.
So. All right. So you know what, Shrub? I'm going to make you a co-host because I don't know who she is. So you're a co-host.
Yeah,
you want to invite her up? Please accept the invite. You can invite her up.
Yeah. Let me see how you do it.
Just hit invite to. You can invite to. Just what you do. Touch on her picture and then hit the button that says invite to speak. That's how you go.
There you go. Great.
Okay. Cool. All
right. I brought her in, but can I just say one thing because I actually
go for it.
Yeah. So just one thing because I need to take the family somewhere. So we've been talking about housing, which is It's an emotional purchase, but it's also the biggest purchase that most people make in their lifetime. So and we've seen this rolling over or peaking or getting anecdotal evidence that something is happening there. But let's put that aside. I think the other side of the spectrum of spending that we should mention, let's speak at the spectrum, at the other side of the spectrum, so the very low priced items. Netflix, 2 million subscribers canceled, right? So Netflix said, oh, it's because of COVID. And then there was a consumer survey in the UK, and that was run by the Bank of England, so a credible one. And it came out that a lot of respondents said that they're cutting down on subscriptions to make ends meet. So a lot of that canceling of subscriptions, and you know my view that Europe is already in a recession. They're already canceling subscriptions in Europe and the UK because the consumer is hurting. So housing aside, if people are cutting down on small items, Netflix in Europe, the big ticket items, they're going to suffer much more.
100% Shrub. And as was pointed out, I think KFAB was going back and forth with me in a Twitter exchange this morning, because there were some statistics put out about consumer savings and debt and all this sort of stuff. And it shows the consumer to be in relatively good shape, but it was correctly pointed out by, I think, KFAB and some others. And KFAB, maybe you could elaborate on this a little bit. You know, there's lies, damn lies, and statistics. So when you look at the aggregate statistics, you've got those at the upper end who are doing extremely well, and they've got a lot of savings. Then you have the bottom part of the socioeconomic strata, and they're getting absolutely destroyed with rising inflation, and their savings, you know, are not in such great shape. They're living paycheck to paycheck. So there's a real, you know, the average doesn't really tell you anything. It's sort of like if you ask people what's the average height of a bunch of, it's two people in the room, what's the average height, and you tell them it's you know, 6 feet tall, and they say okay. But then you find out it's you got Shaquille O'Neal at 7'2", and you got Muggsy Bogues at 5. It was a former NBA player, 5'4". So it doesn't really tell you anything. So there are a lot of people who are getting really smashed by what's going on, despite what the aggregate statistics will tell you. KFAB, did you want to weigh in a little bit more on those stats?
Yeah, just real quick. I encourage people that haven't to check out Hoisington's quarterly that just came out yesterday. And in that, Lacey Hunt went through, I mean, basically you've got 170 million people in the country, roughly, that had their income drop in real terms over the last 12 months. So relative to what Shrub's saying, and that's even worse probably in Europe, is my guess. The flip side of that, and this is an extension of that is I haven't heard or seen any data, but another shoe to drop could be withholdings for retirement savings as people kind of chop, you know, so-called discretionary. And I wonder how much that could potentially hit passive flows as people, you know, eliminate their 6% or whatever payroll deductions that they're plowing into retirement accounts. Because I mean, you know, let's, if you even just back out the retired folks living on fixed income, where Social Security I think was like 5.8 COLA, you know, and I always I say it tongue in cheek. I mean, for me, it's like a crime against humanity, but I call it the phony baloney Boston Commission inflation data. That's using the phony baloney inflation stats. The real stats that people are actually facing in life, you know, probably 10, 12%. And they're getting 5% COLAs. I mean, people are just getting absolutely roasted with the inflation.
So that's a great point, KFAB, and points to why also when we talk about where to be in the market, where to be invested, I try not to get drawn into individual stocks because I don't want to get into compliance. I don't have a compliance issue, but I don't want to be responsible for people's what they do. They got to make their own decisions. One of the reasons why I continue to be consumer stocks are just going to complete. It's why they act so badly. They're going to continue to act badly because real incomes are getting destroyed, as you rightly point out, KFAB. So, you know, there's a Kathy Wood stocks, there's a consumer stocks, there's a tech stocks. There's these are just all completely no-fly zones. And so I think, you know, yeah, we're gonna have a slowdown, eventually get a recession out of this. I'd like to go to the individual who operates an oil rig. So Christine, welcome to the room. Thank you very, very much. I guess you're a friend of Shrubs. Thank you for your generous contribution to World Central Kitchen. Um, it's just wonderful. We all give to our own ability. I fully understand there are some young people in the room. Maybe they're students who have negative net worth. That was me once upon a time. Send in $10. That's fine. But some of you have given very generously in the thousands of dollars. And Christine, I'm very grateful for your contribution of $2,000. So, Christine, do you want to share your insights about energy or whatever else you'd like to talk about? Welcome, Christine.
I mean, I don't have any, big mic dropping insights right now. I just wanted to go ahead and thank you for, um, reminding everyone, to donate at this time, and especially people who've made money in oil and gas, and people who follow me, they know that the last 2 years, I mean, I crushed it. Like I literally sold my house to buy oil and gas in 2020. So you can imagine how much money I made, especially since I leveraged all that. So and but it's a solid reminder that everyone who's making money off of the price of oil and gas going up here. I mean, there are side effects and consequences to that. And the number one side effect and consequence, is food insecurity. We've got millions of people, slipping into food insecurity, month over month. And, a lot of us in North America, I mean, we don't get that. We have social systems that allow, our poor to go get food and to be part of programs. And most other countries in the world, I mean, they just don't have that. So trying to get those organizations the proper funding so that they can help reach those people, and I mean, you're literally saving lives.
Thank you so much, Christine. That's terrific. As long as I got you up there, I'm just kind of curious. What is your take? I mean, obviously on energy, obviously it's been great the last couple of years, but the past is prologue, and you're only as good as your last trade. So, are you inclined to be? You don't have to talk about individual names. I don't want it to be too personal, but are you hanging on to what you got? You still think the future is bright? Or are you worried about the stocks turning down if we get a recession? Or where's your head at with respect to energy investing right now?
So, kind of my take on the situation is that many generalists still don't believe in oil and gas. I think that there's still kind of this idea that somehow oil's going to go back down, to $60 a barrel, and a lot of that is propagated, by the political rhetoric that we see and hear every day. So kind of what I see happening is, us potentially staying like in this consolidation realm with the equities, but eventually there's going to be this aha moment because politicians are going to have to start explaining to the public why oil prices have stayed high. And I don't see any big pullback to $60 a barrel, which is why I believe that oil and gas will stay high. Inflation adjusted, $80 per barrel in 2014 is $100 today. So where we're trading today is really only $80 per barrel in 2014, and you can go back and you can see that during the last cycle, oil, for years it consolidated in a healthy range, around $80 per barrel. And so kind of what I see happening is us achieving some kind of consolidation zone, and it's kind of hard to pinpoint exactly where that's going to be because we still have all this noise in the system because of the sanctions and what's going to happen with the Russian barrels. And uh, people are figuring out how to absorb them right now because so long as a ship's cargo is less than 50% Russian oil, it's not considered Russian anymore. So, I mean, there will be ways that things get worked into the system because there's just no way that the world can wean itself off of Russian barrels because there's just not enough global supply. So that is creating this noise and uncertainty. But the price of the equities, I mean, they really, even where equities are priced right now, they're not reflective of the current price of oil. So there still needs to be some adjustment there. I'm still overweight oil and gas. I mean, I significantly hold oil and gas in my portfolio, and it's just subsidized a little bit with mining and some finances. And then I also own real estate. It's kind of been like my side hustle for the last 10 years. So, so yeah, I mean, I believe in real stuff. I believe in hard assets. I believe in value, and that's how I'm positioned.
That's great, Christine. Christine, let me ask you: are you at all? Shrub, sorry. Let me ask Christine one question. You go ahead, Shrub. Christine, how do you think about the potential for any correct? Even though, so let's say secularly, I agree with you. Are you at all concerned if we hit this air pocket in the economy and markets that you may have to give back some of your ill-gotten gains here for the next few weeks, just as you did the last couple of days of last week? Do you think some of these stocks could be vulnerable in the short run?
I mean, it's anyone's guess whether or not a big market correction is going to cause some hedge fund to blow up, which uh, basically cascades into other sectors, including ours. I mean, you guys are financial people. You trade all the time. I mean, that there's these ripple effects in the system. And for me, the ripple effects in the system has always been my biggest risk here.
Got it. Shrub.
Yeah. So the one takeaway I got from Christine, and I'm just going to do it as a leading question because that was an eye-opening moment for me. So we've said this before: 40% of people that worked in the oil and gas industry have left the industry since 2014, and 40% of offshore rigs have also left the industry since 2014. So now, Christine, you used to work on a rig, and you said that if you were going to go back on a rig, you would need how many months of training again? So just to show people the lag between now prices at 100, the lag of getting good people like yourself back on a rig and back into production.
Yeah, so my background is I used to be a drilling engineer. I was a senior drilling engineer, and I've actually drilled deep water wells, all around the world. I've also got an MBA, and I've worked as a economic advisor, decision advisor, and portfolio advisor for major capital projects and for basically new country entry and project advancement. So, I've got a perspective of oil and gas at the bit, as well as, a high level perspective in terms of where companies are going to spend money point forward. And when I say companies, I mean majors, because I never worked for small caps. I always worked for large companies, large multinational companies. So anyway, let's say I went broke tomorrow and I needed to re-enter the industry. Even, with 20 years of experience, which I have, I haven't worked in the industry since 2015. So all of my certifications, I mean, they're all expired. I could pick up the phone and likely get hired, within a month, but it would probably still take 3 months to fully onboard me because of the hiring constraints and how they have to basically post jobs and get a number of resumes and go through a vetting process to prove that they're not discriminating before they actually hire someone. And then once I got in, it might take me 3 to 6 months to get all the safety certifications to get back on the rig, to get my OSHA cards and my, basically water survival and, H2S gas and just, I mean, there's just like a plethora of certifications that you need. Now, if you're working for small companies, and maybe they're less rigorous on some of these land operations. I mean, it might be quicker, but if you're working for a major, that, like I said, there's a process. I mean, when I went to work for Chevron, from the time I interviewed with them to the time I walked in the door was 6 months. And I was already working for another company at that time. So, I mean, I didn't need any certifications. But again, it's just the hiring process for a major, it's cumbersome.
And that's a problem. We had the war in Ukraine was a month ago. So if you're going to ramp up operations, if you have the good people, it's going to take you at least 6 months to get the oil out of the ground. I mean, and to get people like Christine as well on board.
Let's just say this. I know recruiters who are looking for recruiters. I mean, it's so the ramp up, like the hard ramp up, I don't think it's happened yet, but they're staging for it right now. There have been a number of job fairs And most of those job fairs that have been conducted have been more for like well site positions and not so much office positions. I do slowly see office positions getting posted. I mean, I'm not looking for a job. I don't intend on ever going back to oil and gas. I'd probably lose money completely focused on what some company wants me providing them data for than watching my own portfolio. So it just would be senseless for me to go back and work for another company. But but I have a bunch of friends who are looking, and for me, it's concerning that they're still looking.
So, listening to you speak, Christine, maybe you could speak generally about the mindset of those who've been in the industry. Maybe not just yourself, but more generally. I can imagine if you lived in the industry and you got axed and thrown out on your butt, and now there's a stigma about, for some people, about working in a industry that's throwing carbon up in the air. So I can imagine for someone thinking about maybe going into the energy industry, a combination of concern over job security, that they fire people like they do, and you're polluting the environment, which is completely wrong, but leave that aside. Like, does that kind of make it raise the bar to try make it more difficult to attract people to come to the industry for the average person?
I think that when you look at the ESG, the woke mentality of they're polluting the industry, that might hurt college recruiters. But people who've worked in the industry at least a handful of years, I mean, they know how hard uh, companies work not to pollute. I mean, like the last drilling rig that I was the senior drilling engineer for, I flew out there, and once I got out there, I was walking around, and I noticed like a coffee cup in a drain, and I reached down and I picked up that coffee cup and threw it in the trash, and I kept going. And then during the next safety meeting, the company man, like, he's like, "Hey, I just want to like point something out real quick." And then he turns over and he asks me, he's like, why did you pull that coffee cup out of the drain, on the offshore rig? And I said, well, because that coffee cup could clog the drain, and the next thing it rains, and then that rain causes any oil that's on the deck to like maybe float up and then somehow spill into the ocean. So I mean, keeping the drains clean is the number one thing that you do to help prevent small spills. And we're talking about oil, so I mean, it doesn't take a whole lot to create a giant oil slick offshore, because it just like dissipates and it spreads so thinly and creates that sheen. But what I'm saying is, that's the mentality of an offshore worker. You're doing everything that you can do to prevent a spill. And even on these land sites, some of the pad preparation for these land rigs, I mean, it's very rigorous. They're scraping the area, they're laying down a barrier. Even if you walk onto a rig and you see what you think might be a spill, the reality is there's another spill pan that's beneath the dirt that you're standing on, that's been laid there to ensure that nothing actually gets into the water table. So people who work in the industry, I mean, they get it. The ESG propaganda isn't going to keep them from getting a job, but what will keep them from going back into the industry is the fact that they've been out for a few years and they now have a different career. So another headline fact that I got, just a few weeks ago from my neighborhood newspaper was that, and I posted this on Twitter a few times. Since 2015, 70% of oil and gas workers in the woodlands have been laid off. When you look
Wait,
at
Christine, stop. Could you please repeat that again? Please repeat that.
Yeah, so since 2015, when the start of the last oil crisis, the dip, I should say the crisis, the commodity price, not the crisis that leads to food insecurity. But yeah, like during the last oil crash, since then into COVID, there 70%, 70, of oil and gas people who lived in the woodlands got laid off. So a lot of people took early retirement packages. And let's say if someone was like in their late 50s and their 60s and they went ahead and took a package and left, I mean, let's face it, like they're just flat out retired. They're not coming back. People in their 40s who that happened to, and I'm kind of like in that window. You know, I was like 40 when this happened, and so I'm 45 now. You know, I mean, we went on to do other things. And so now what oil and gas is going to be competing with is trying to attract people away from whatever they navigated to. And like for me, you know, I've been super successful, so they're never going to be able to track me. You know, I've got friends who have 3 kids now, and they started businesses, and they're home every night, and they're not going to go back to being a directional driller offshore and gone for a month at a time. You know, they've acclimated to their new lifestyle, and they like their family, and they want to be home. You know, and then I have other connections that I know that work on rigs, and they're still, you know, doing what they're doing, and they're kind of like in this show me the money uh stage, so they'll eventually hoard themselves out when the money's right. You know, so yeah, I mean, the industry is just competing with a lot of factors, and the pool of people is small, and the conception that we can ramp up quickly is, you know, it's a fairy tale. It's not going to happen because the people aren't there and the materials aren't there. And it's not like we're only missing one, you know, we're missing both.
That's Christine. It's really, really interesting to hear that from you because you're an expert in the industry. I want to go to Oil God. Oil God, if you have a question for Christine, I think we're really fortunate to have her here. So if there's a question you'd like to direct towards Christine as someone who actually works in the industry, Oil God, I know you're in the industry as well, but maybe from a slightly different perspective. And then after Oil God, I'd like to go to Three Aces. So Oil God, the floor is yours. Are you there?
Yeah, thank you for that, George, and Christine. Thank you for your donation. I do have a question, and this is because obviously we're in agreement on obviously the space of obviously energy in the undersupply, the lack of talent, infrastructure, you name it. I mean, I think we're all on the same page with respect to that. Christine, the question that I have that perhaps you can help with George, he was asking you, coming weeks and this and that, and you've obviously seen different oil equities respond differently in the last 48 hours, 1-2 weeks, up and down and whatnot. But would you argue that this time is different largely because the balance sheets of these businesses are materially changed, as well as the actual operations from a board of directors levels, management levels, how they're compensated? And then also when you pair that with, lack of talent, lack of supply, and then you listen to one of George's keynote speakers saying where you want to be invested going into a market like this, which is boring, free cash flow, not a lot of risk. I mean, I think there's a misconception that oil equals risk, whereas what the rest of the world is now figuring out is oil and energy is lifeline, right? And George, I'd like you to come back to me after Christine asks this when you have time, because I do want to pair back a previous conversation, even one that Three Aces asked with leading with real estate. But I'd start perhaps by asking Christine how she feels about those sort of topics that I just laid out. Thank you very much.
Christine, the floor is yours.
So, right now, I mean, we know that most oil and gas companies are profitable, so long as they can, maintain their production, that they have sufficient rigs to basically toe the line and keep going. I mean, it's a safe investment. We know that, but we're a small number of people. So I kind of want to go back to my ripple effects, the ripple effects of things that are happening in the stock market and with other companies that are outside of our industry not doing good and creating big drawdowns in hedge fund managers' portfolios. That's our big risk, because what was happening yesterday wasn't people selling, it was algorithm selling. And even though it feels like we took a big haircut over the last 1 or 2 days, I mean, if you zoom back, the stocks are basically where they were trading 2 weeks ago. So, I mean, I don't get caught up in day-to-day moves. I'm kind of more in the rhythm. I don't know why this thing's echoing back at me, but hold on. Let me mic off.
And mic back on.
I think George's speaker is on. George,
No,
I
it's
can
not.
speak
I'm
to
not
this.
it.
I
I'm
can
quiet
speak
on
to
my end.
Christine's comment as an algo guy, if you're
All right,
interested.
so hold on. So Christine, why don't you just hold? Yeah, so Christine, why don't you hold it for a second, and then Illinois, why don't you weigh in, and then Christine, you can come back in.
Sure. Assuming that the DE Shaws and the Rentechs of the world have this stuff in their portfolios, what they're doing is they basically have a series of alphas. Probably, it's probably being driven by, free cash flow, expectations of free cash flows, the price, along with a lot of other different things. But assuming that, the hedge funds with their alphas are seeing some of the same stuff that we're seeing, it's getting fed into Portfolio Optimizer, and they're trying to basically maximize expected returns minus risk or volatility. It's basically, the old solution of alpha sigma inverse. But when you have a situation where volatility increases and there's a call on liquidity at some of these big funds, I don't know if that's going on, but let's assume hypothetically it might be at some of the bigger firms. Then what the optimizer is going to do is it's going to say, hey, wait a second, specific risk is going up in these stocks, sector risk is going up in these stocks, and we need to reduce our position sizes. Because again, the proper positioning in the portfolio is your expected returns divided by your expected volatility. So if the denominator increases, that's going to kind of nudge you at a lot of these stocks. And if it's in the small cap space, and they've been building a position for a while, that's going to be a really big call on liquidity from the markets when they try and sell out, and that's going to move prices down. And that could be what's happening right now. I don't work in the space anymore. You have to accept a couple of hypotheticals, but that might be what's going on.
Yeah, Illinois, that's entirely plausible, and I like Christine, and I want to come back to her. I also don't get caught up in the day-to-day machinations of price. As Christine said, and I guess this is Twitter speak. Prices of Canadian oil equities have crashed to levels not seen since April 10th or whatever. I mean, it's a joke. It's a freaking joke. And anyone who's on the edge of their seat because they get odd jock because prices go up and down 5 or 10% in a few days just shouldn't be in these stocks. But I actually think it's a good thing because it shakes out. There was a guy, Ken Hebner, one of the great investors of our time. He's seen his better days, but he's an older gentleman now. He runs capital growth funds out of Boston. He was a peer of Peter Lynch. I learned a lot from Ken. And he'd get very excited about stocks, but it was always know what you own, which, as long as I'm mentioning the name Peter Lynch. Listen, if you own these things on 2 times cash flow or whatever, we all heard Eric Nuttall, by the way, commercial pitch. We had Eric Nuttall in the room 5 days ago on Monday, the preeminent Canadian energy investor, bar none. I urge you to go listen to the replay. Combine that with the replay of his webinar where he interviewed Mike Rothman, in my opinion, the best analyst on the street of Cornerstone Analytics. Actually, I get confused between Cantor's firm, and they're both Cornerstone. But anyway, you have the best oil barrel counter, Mike Rothman, being interviewed by Eric Nuttall 2 weeks ago. And this past Monday, Eric Nuttall graced our room. So if you want to get up to speed on energy, in my view, again, do your own work, but in my view, those are the 2 best guys out there. And it's know what you own. At the same time, we're talking about, oh my God, what happened? Chicken Little, the sky's falling. These stocks got schmiced the last couple days. And Illinois is probably right. We always want to attach reason or narrative to something that's going on. And the fact of the matter is, I've been beat up enough and I'm humble enough to just say, you know what? I don't know. I can just see what the price is on the screen. And if these things aren't 2.5 times cash flow, okay, fine. Let somebody sell it. If I channel my inner Peter Lynch, I'd say, oh, actually, that's a good thing. Why is it a good thing? Well, it's because I get to buy more at a lower price. So, again, to paraphrase Oscar Wilde, I put that in my Twitter feed. It's a play on words. people know the value of everything. Sorry, the price of everything and the value of nothing. And that, by the way, is really the problem with so much of the stock market. I'm just going to go off on a tangent here. So you have these hundreds of billions, trillions of dollars that have gone into the market, buying index funds, buying the Cathie Wood stocks, et cetera, et cetera. And you've had this complete gamification of the stock market. People just, they don't know what they're buying. And as Peter said, and I'll repost the clip, there's a great clip from Peter in 1994 in a speech. Because they're buying it for one reason and one reason only, because that sucker's going up. They're momentum buyers. And it was going up too much for too long. And that's really, that the blame for that lays at the feet of the Federal Reserve. Because everyone's been trained in Pavlovian fashion now to buy the dip. And you buy the dip, and you buy the dip, and you buy the dip. And it kept working, and it kept working, and it kept working. Until one day, it's like the little boy that cried wolf. And guess what? The dip ain't bought. And the problem with that is when you have price insensitive buying, where there's no price discovery, and let's say Oil God does his work, he's a good guy, and he's like, you know what, I'm only going to buy things that make sense, or three aces. And it's like, you know what, let those crazies pay that price. This doesn't make any sense to me. Once the price insensitive buyer's done buying, and let's just take I don't know, Tesla or whatever, or let's say Shopify. Oil guy, where's Shopify now? I'm not even sure I know where it is. Where is Shopify?
It's under 600, George.
Okay, so Oil guy, what do you think is the fair price for Shopify, Oil guy?
Probably 200.
Okay, and how high did Shopify go?
2,000.
Okay, 2,000? You serious?
You bet.
I lost track. Okay, so Oil God's got a bid at 200. And the price keeps going up, 300, 400, 500, 1,000, 2,000. He's like, now, he may have FOMO, but I suspect he kind of lights up a joint to kind of cure himself of the FOMO. But whatever. If he's got discipline, he's saying, the hell with it. If he's a know-nothing and is jealous because he's at a cocktail party and all his neighbors are buying Shopify or some similar merchandise, he'll get sucked in. But he doesn't know what he owns. He bought it for one reason only. This is a hypothetical shot. Oh, God. Because it was going up. And now when it starts going down, like, what's he going to do? Oh, he should sell because it's going down. And the problem I have with the market, so much of the investor base is of that ilk. And they've been trained stocks for the long term. Jeremy Siegel, stocks only go up. Oh, if I sell, I have, I'm going to have to pay taxes. If I sell, I got to figure out when to get back in. Blah, 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 blah. And so what happens is they don't sell. And Michael Green has correctly pointed out the passive bid, the ongoing inflows. And he's been right. But it doesn't give you any clue as to when the worm is going to turn. It may be turning. I think it is turning. As a matter of fact, I think those price incentives to the buyers, they're going to be the bag holders. Think about it. The average stock is down 40% or whatever it's down. The indices are, it's S&P's, whatever it is, 10% down from its highs. NASDAQ is worse. So, but the average stock is down a lot more than the indices. And think about all the damage that's been inflicted on Shopify and Cathie Woods and all this other garbage. And that's with all the inflows. We've only seen 2 weeks of outflows. Could you imagine how much the market's going to go down if the passive bid goes into a reverse? Can you just imagine? So my question to everyone in the room, what I would ask everyone is, what is the expected? Do you think it's a good bet on an expected churn basis to say, okay, George, you're wrong. You know what? I'm not going to sell because you're wrong. And I'm going to prove that you're wrong. And the market's going to be flat. It's going to be a stock picker's market. And as I put in a tweet just earlier this morning, whenever you hear it's a stock picker's market, as John Roca was here, he's not here anymore. It's his line. He goes, when it's a bull market, you never hear anybody say it's a stock picker's market. They say it's a stock picker's market when nobody's making any money. And that's what's going on right now. And CNBC and the street and all the fakers and Twitter and everybody else, sell is a four-letter word. I argue if you can't stand the heat, get out of the kitchen. Go to cash. If you're half crazy or a pro and can stomach it, short something, or even if you don't want to go to cash, like if you say to me, hey, George, you know what? I want to sell something because I'll have to pay a lot of taxes. Okay, fine. So why don't you buy some put options on something else to hedge yourself? Why don't you go market neutral? I got into a long discussion the other day. I'm not going to mention his name, but Bad Boy knows who it is, Mr. Detroit Bad Boy. This guy does really, really good work. I don't have I'm old enough now. I don't have the patience for detail to go that deep on the work. So I will cede the knowledge advantage to him on any individual stock. So this is a stock. I'll tell you the name of the stock. It's Kornit, KRNT. They have this thing for automated. They have this automated T-shirt thing where basically they can produce T-shirts. It can come. Oil God wants to come up with a Canadian Oil Mafia T-shirt. He just sends the design to them, and they have this special fabric and computing thing, this CAD/CAM thing. They can make T-shirts with a special procedure just like that. And the oil God says, you know what, we don't need 10,000, we only need 100. Or Sohaib says, no, we only need 50. Sohaib, by the way, is in the third row. He is he's the head of the Canadian Oil Mafia. So they can just push a button, and there go the T-shirts. So Kornit's a great company. But there's a difference between a company and a stock, and people forget that. So Kornit went from I first heard about it, went from 15, I think it went to 180. Someone should look it up. It's KRNT. And the PE went from nothing to, I don't know, 200 or something crazy like that. Well, we had a discussion the other day at 70. He calls me up. He's like, what do you think of Kornit? And I had told at 150 we had the discussion. I said, listen, so good on you. This is a great story, but you've been overpaid for this idea. This valuation makes no sense. I think the estimates for this company from memory are something like $1.10. This is a real company, okay? $1. And by the way, I think these may even be non-GAAP earnings, not even GAAP earnings, but just humor me for the sake of the argument, illustrative purposes. $1.10 this year and $1.50 next year, and he's convinced that in 2026 they're going to make $5. Okay, but I'm like, dude, the stock's at 150. It's 130 times this year's earnings. It's 100 times next year's earnings. It's only growing 25% a year. What are you doing paying 100 times earnings? Are you nuts? Well, da 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 da. I said, do you realize that you're implicitly buying, a long duration bond when you're buying this thing? It's like, look at the volatility in a 30-year zero. Well, it's got good management, and if I sell it, blah, blah, blah. Okay, that was 3 months ago. Nothing's changed. He calls me the other day. Nothing's changed except one thing, the price. It's now 70. I said, dude, that's not his name. I just don't want to give up his real name. I said, dude, what can I tell you? I mean, look at the chart of the 30-year zero. Look at how much that's gone down. Look at the chart of the Austrian 100-year bond and see how much that's gone down. When you buy a long duration asset like this, or Shopify, or Tesla, or Cathie Woods, you're buying an embedded 100-year, 30-year, 100-year bond. People don't understand that. So people talk about the earnings and the sales and what a great company is, and great management. And you have cognitive bias participant bias because you own it, so it has to have good management. That's not the point. The point is about liquidity. It's about interest rates. And that's why we have Michael Howell come into the room. So I told him right now, I said, look, at 70, they're going to make $1.15 this year, $1.50 next year. It's still 45 times earnings. It's a great company. I've seen the company 2 or 3 times myself. Again, this is not investment advice. Do your own work. I said, if you tell me, I believe rates are going higher. If rates are going to 3.5, let's say in the 10-year, I'm reasonably certain this stock is going to go down to 50. He's like, well, what should I do? I said, well, if you're convinced it's a good stock, why don't you just short Cathie Woods against this, or buy puts on Cathie Wood, or puts are too expensive. Buy a put spread. So at least you don't have to pay the capital gains on selling Kornit. And in any and all scenarios, you would expect Kornit to outperform Cathie Woods. So all I'm saying is people have been hypnotized, become complacent by this ever-running, long-running bull market, this endless sea of liquidity. It's sort of that Minsky moment, and I think that's kind of where we are, but do your own work. So, I could be totally wrong. Wouldn't be the first time, won't be the last time, but that's just my 2 cents. Oh, God, you have a response, and I want to go back to Christine.
So, listen, I wanted to actually just pair everything you're saying with the conversation that happened a little bit earlier. And I obviously sound extreme because it's 10 in the morning on the West Coast. And I know, George, I have not wake and baked, as we call it here. But really what you're alluding to is the fact that people, if you want to protect your money, you have to start thinking away from the herd and where the herd is going to get hurt. So what you're saying, George, makes absolute sense, right? Don't follow the herd with your stock portfolio. And also think about the question with respect to real estate. And then think about who's tied into who and how that works. And I'll take you back to 2008. And George, you remember this. When the stock market imploded, there were obviously stocks that got absolutely trounced, went down 50, 60, 70, 80%. And then they're the ones that outperformed. And the ones that outperformed that would surprise many people on the call today would be things like Hugo Boss, Tiffany and Company. Why? Because the people who have that kind of money, who purchase those kind of, products, they're not largely affected by interest rate moves. They're not living paycheck to paycheck. And so no matter what we are all thinking, you need to protect yourself and your portfolio away from the most vulnerable, which includes real estate. I think condominiums, long-dated condominiums, pre-sale condominiums haven't been completed yet. And now our friend of the Canadian Oil Mafia, Abe, is spoken about this at length. Those things are going to get crushed because when heating bills, with your food bill, plus your mortgage bill, all goes up at the same time, those are the people that are the most vulnerable to needing to make a lifestyle change. Right. And so the same thing happens with a stock portfolio. If you didn't know how to invest, well, what are you told to do? You're told to go and buy a mutual fund, an exchange traded fund. If you don't want to invest with mom and dad's guy, and you want to have a fearless portfolio that just tracks what everybody else is going to buy. Well, remember, the more you're tied to everybody else, the more you're tied to the volatility. And I'm going to tie this into what, this is all cute past performance bullshit. This is not what I want. But if you're all on the internet like I am, and you're seeing Twitter, and you're seeing videos from the United States of America, what you're seeing is desperation. And you're already seeing it. I saw a video the other day of a couple walking into a restaurant at gunpoint, literally going table to table, stealing the food off of people's plates and leaving. I saw another video in America where a woman comes out of a grocery store, literally parks her buggy in front of her car, opens her trunk. Somebody comes and accosts her, and another woman comes, puts her car next to the other car, and starts stealing her groceries. Folks, we're 2 fucking months into this war with Ukraine and inflation. And so where am I going with all this? Think of what an electric vehicle symbolizes in the next 1 to 2 years. We all know the prices of them are going up. Forget Elon Musk and the fraud, and I know 3 Aces myself. Many of us all agree there's a lot of bullshit there. We all saw what happened with Rivian. They needed to increase the prices. People freaked out. They said, fuck that. And obviously the stock got hurt. But I want you to fast forward with me. Let's all smoke the joint together. Okay? Fantastic. Now we're all on a voyage. It's 2 years away. Okay? George, you look better than ever. You age like a fine wine somehow, right? And so we are all looking at the news and we're seeing electric vehicle lineups because there's more on the road. Who can afford them? The people that are wealthy. Why are they charging them? Because they ran out of electricity, right? Forget the 55% backed by coal and fossil fuels. And this is not what I want. But what these people are signifying is the sitting ducks from a safety perspective, because you can't move. That's why you're waiting to charge your electric vehicle. And somebody with a gas and a gun literally could come and put you and your family at risk, whether it's theft or God knows worse. And I'm not looking for this, but I'm just telling you, electric vehicles could actually do even more social harm than you probably even are pricing in
So,
today.
Oil God, brilliant. Just so you know, I don't want to go down an electric vehicle rabbit hole. We're going to have Gordon Johnson come here one of these days to go down that rabbit hole. But there is so much ignorance around CO2 emissions. And I'll just put this fact out there. It's not an opinion. It's a fact. This is a fact. You're entitled to your own opinions and not entitled to your own facts. If the entire automobile fleet was replaced with electric vehicles tomorrow, the entire automobile fleet, it would result in approximately a 10% decline in CO2 emissions. 10%. That's all. Despite the trillions of dollars that we require to do that. So, I'm all for green and a healthy planet, but there's been so much misinformation put out there that I think as Europe certainly is out in front, running, not walking headlong to an energy crisis, self-inflicted, I'm hoping that there'll be a re-examination of this issue. However, I fear it will only occur once we have a full-blown crisis. Let me ask a general question before. I know Brian's got his hand up, but I want to, and Paul hasn't spoken yet, but I haven't been exactly of the bullish persuasion, as many of you know, the last few months. I'm not a perma bear, but I am a skeptic or a cynic. And I come into these rooms, and I don't, I'm not totally neutral. I state my opinions, but I try to offer up facts as to why. I would invite anybody in this room to try to cheer me up and tell me why I'm too bearish. Because I come into this room, there's a ton of smart people in here, and I'm always learning in these rooms. I learn from you. And I listen to you. One of the things I like of listening to others, it takes me on my own personal thinking, which is a personal hell. And I listen to you, and I just get more bearish. Could someone please raise their hand and come up and give me the bullish case and tell me about why the equity market, why I'm too negative, all right? Because I'm having a hard time. I'm having a hard time getting there. I mean, it's like it's always, as Stan Weinstein says, you look at the cards coming out of the deck as they come out. It says at the margin, information more bullish, less bullish, whatever. And I just get more negative by the day. So with that, I want to go to Paul, and then Brian, and then Marcellus. Paul.
Hey George, thanks for having me or letting me up. A couple of points. I think I'll probably try and answer, or not answer, at least express my thoughts on what you just said. But before that, we all talk about oil, and no doubt about it. That grabs most of the headlines. But let's not forget natural gas. This country runs more on gas, or at least as much in gas as in oil. We consume about 16 million barrels equivalent of natural gas every day, against the 20 or so bottom line number on oil. So it is as much a significant impact to sort of the Johnny Lunch bucket, which we all are at the end of the day, on inflation and everything else that goes with it. And what's happening in the gas space is, I'm not sure what the right word is. A travesty, or is it just? I mean, we're about to build this plethora of LNG terminals, and we've gone from $3 or so, or 3 and 4. We've doubled to maybe 6 and 7. Europe's paying $20-30. There's no reason they'll ever pay anything below $15 to $20, because that's where other fuel switching comes in. But the bottom line is, if we go to $10 and stay there, this is catastrophic for the common man. Not just from an energy perspective, heating bills, electricity bills, food. I mean, you name it. Oil is just about filling gas in your car, but this, as I said, this has a much bigger stealth impact. Yes, there's money to be made, no doubt about it. And I'm sure people smarter than me know how to make money on this, and that's what I do for a living. But nonetheless, that's one thing that we all should remember, which is even more bearish case, to your point. And the bullish case, again, I'm not an expert on currencies here, even though I've traded them and I watch them. Look, ultimately the Fed's going to relent. They have to. There's no doubt about it. These currencies, when I look at the yen, we all know the story here. I'm not going to repeat it, but eventually, this is just my opinion. The strength of the dollar really has, some very transient arguments to it. Ultimately, it'll go the way of, I'm not sure which currency, is it the yen, is it the euro, or what? And for now, we're the cleanest shirt in the laundry, I guess. And once that goes, I mean, what do you do when everything's debased? You have to own something. You cannot own cash. It's going to get debased a lot. And so I'm not saying that that's the bullish argument. I'm certainly not betting on that thesis. But eventually, a time will come when the currency will become a bigger part of the topic of discussion. That's all I had. Appreciate it, man. Thank you.
Thank you for that, Paul. Really appreciate it. All right, let's go to Brian and then Marcellus. Brian?
Yeah, hey, George. Just thanks so much for hosting these spaces. They've just been great, and I've just loved listening to every word. So I actually have a question for either you or just the space in general. So I'm in agreement with, what we talk about a lot about the oil stocks and commodities and all those kind of things being a good play here. But then on the other hand, sometimes we talk about stuff, I hear you say a lot that equities are return-free risk right now. And we're also currently today, we've been talking about, liquidity and tightening. And, the last couple of days, this big sell-off we had. So I'm wondering, at least in the near term, do you have any opinion on how the tightening and liquidity issues will affect, stocks across the board, like oil and commodities?
So people who've been in this room know that I'm generally negative on things. But in particular, I've been most negative on the things that are most susceptible to changes in liquidity and rising interest rates. So long duration to short duration, generally value over growth, commodities over stocks, commodities over short duration assets. So in that context, my only longs this year have been energy stocks and some gold. I had a little feeling a few gold stocks. They're not doing so well the last few days. We can talk about that. So if you ask me between now and the end of the year, like, what's going to happen to oil stocks, I expect energy prices to go higher. The only way they're not going to go higher is if we get a full-blown recession. I don't know if the Europeans are going to go through with it. But keep in mind, this was the week they threatened they're going to implement full embargo against Russian energy, Russian oil. And oil demand tends not to fluctuate as much as it's changes in supply, which are much more important than changes in demand. Demand goes up and down a little bit, but supply, which takes years to change. It's only been 3 years in the last 50 that oil demand's gone down. So the delta has always been supply. Obviously, 2020 with COVID, that was one of those years. There was a big collapse in demand. So the issue really is supply. Always has been, is, will be. And if you were in the Mike Rothman or Eric Nuttall rooms the last couple of weeks, I think it's only, unless we have a big recession, which I don't expect, it's only in the next few months you're going to see people starting to worry about how much excess capacity does OPEC have. In recent months, OPEC has been unable just to even keep up with the quotas. So that's a tell. Which is why when we come back to what the Fed is doing, we have an inflation problem. How much of it is because of the pandemic? How much of it is because of monetary policy? How much of it is because we're running out of, there's been massive underinvestment in extractive industries. The Fed can't do anything about that. Ditto for, agricultural products. So you could have a situation, and I think it's pretty good chance it's going to happen. It's my opinion. Do your own work. That we get a slowdown. Detroit Bad Boy was talking a little while ago about the abrupt decline in transaction volume at PayPal and Wayfair. I also was doing some work, was in contact with a very large consumer products company you would know. It's a company like Weber Grill. They make a consumer durable. And in that switch in consumption from consumption to goods, their business boomed during the pandemic. Well, they're seeing their orders fall apart as well. So I could totally see where the economy slows down and we go into a slowdown. Maybe it's a mild recession. So I'm not going to argue about that. But what it means for inflation is not entirely clear to me. The promo bulls would have you believe inflation is going to go down, no problem, rates go down, blah, 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 Goldilocks is back, live happily ever after, Shopify's good to go. Buy Tesla, buy Cathie Woods, and we're good. I think more likely is a scenario where you get a slowdown in the economy. You certainly get an earnings slowdown, if not earnings recession. Maybe we get an economic recession. The way these things work, everyone's going up and down, yelling, waving their hands up and down about, flattening yield curve, this, that, whatever, recession. Everyone's a yield curve expert. Well, when I read that stuff, they usually say it's like a lag of like 12 months or something like that. But what's more important than whether we get a technical definition of a recession, I don't want to get into an IQ contest about that. That's not what this is about. What's happening to earnings and what's happening to interest rates. And I think earnings are going to come under pressure. They're starting to roll. Michael Kantrowitz has spoken eloquently on that. And I think rates are going to remain elevated. I think they're going higher from here, actually. But so a combination of rates not coming off, earnings rolling, increasing uncertainty, the geopolitical risk, who the heck knows what goes on. It's all downside, no upside. So coming back to the question, I'm kind of rambling here. I think energy is going to do well, certainly relative to Cathie Woods. My favorite trade, I recommended this going back to last summer. You can go look at my Twitter feed. It was long XOP short ARC. I stopped looking at it. I don't know if it's up 200% or 250%. It's absurd. I think there's more where that comes from. As recently as 2-3 weeks ago, I was saying I thought that could go another 100% before year end. So to me, the risk on the oil stocks is a generalized market decline. So yeah, I took some licks this past week. Overall for the week, I think I was kind of flat. And early part of the week, I was making some decent money. The oil stocks are doing great. Cathie Woods was not doing so great. And then I got schmeiced the last couple of days because the energy stocks took it on the chin. But so long and short of it is, in a generalized market decline, there's no place to hide. And the oil stocks, yeah, they're short duration, but the perception will be that oil prices will go down, and therefore, earnings estimates will go down, and blah blah blah. So they'll probably get hit. But that's not where the energy is relative strength in the market. It's what you want to buy. So I own energy stocks. I'm not going to talk names. I own some of the Canadian ones, more than the American ones, for all the reasons that Oil God and Marcellus have spoken about, and others. But I'm also short a lot of the garbage. So I kind of I'm hedging the market. Because I think the market goes down. And so if the market goes down, say the S&P goes down, to 3,500, just making up a number, which is totally, in fact, if you said to me, George, how low do you think the market's going to go? Just to sort of contextualize my bearishness, not holding me to a 1-point forecast, but the S&P is wherever it is, 4,300. I've lost track. Is it going to 4,000? No, it goes lower. 3,800, lower. I don't know. So yeah, I could easily see 3,500. And in that context, I expect everything to go down, including the energy stocks. So I hope that answers the question. Christine, the floor is yours. What's up, Christine?
Yeah, I just wanted to kind of chime in because a couple speakers ago had expressed some concern over the price of natural gas. And my take on the situation is that the price of natural gas has simply been catching up to oil on where it needed to be. So traditionally, we've kind of valued things as as natural gas should be about 1/12 the cost of oil. So if oil is 100, I would expect natural gas to be 15 because of all the price shocks and the commodity wars occurring in the world. Natural gas has basically been treated like a waste product, and that's why it was trading so low and not even really getting disposal value for the natural gas. Like it was actually more valuable to re-inject it and help support the pressure drives of your reservoirs than it was to sell it. And now and during that same time that natural gas was like super cheap, we were continuing to do a bunch of coal to natural gas power shifting. So over, the past decade, we've actually been increasing the value of natural gas, but it wasn't being seen in the market because of the price wars. And now all of that churn is working its way out of the system. So yeah, I believe, $7-8 is kind of like a right price for natural gas. Now, what's happening in Europe is truly, a travesty that they're having to pay 20 and 30, but that's also their own fault, because although we do have more than enough natural gas in the ground to support us, what we don't currently have is enough pipelines. And it's just like, we're like, states and our federal government, they're not giving out the land use permits and things like that, so that's needed in order to put a pipeline into play. So soon we're going to almost start bottlenecking ourselves on our natural gas production if we don't start getting more pipelines built. So that's just kind of something to think about in terms of what's been going on with natural gas.
Guiding Hand, welcome to the room. What's up, Guiding Hand?
Hey, George, just quick question. So you mentioned that you use a hedge through ARC. I'm just wondering on your thoughts of using a different hedge through either a small cap ETF like IWM, or potentially like a single individual tech stocks. Because right now, how I see it, a lot of the damage has already been done in the growth sector. And in the rising rate environment, there might come a time where small caps might perform even worse than the tech stocks.
I think each one, I don't want to get drawn into individual ideas. Instead, we try to teach people how to fish instead of giving them a fish. Each one of those instruments has a different risk reward profile. When I was speaking about Corneat earlier, the fellow with whom I was having a discussion, we had spoken a few months ago about this, and he actually, I think, shorted a little bit of IWM as a hedge against his Corneat, but he didn't listen to me. I told him to do ARC because I was worried about interest rates and long duration. So instead, he shorted IWM, and that wasn't a very good hedge. IWM is really kind of a mess. It really is a very dirty ETF. It's got all types of garbage in there, GameStop, AMC, all this stuff. So, and then when you start getting into individual stocks, you got to know the particulars. So it's a seemingly simple question you ask, but the answer is much more complicated. Heretofore, ARC has gone down more because it had the longest duration and had the highest beta. If we're now going to move to an area where we're talking about a possible recession coming down, and you think rates aren't going to go up so much more, it may well be the case that you'd rather be short the S&P or the Russell. But you have to think about, what are you trying to hedge against? Are you trying to hedge against a generalized market decline? So if it's cyclicals more generally, yeah, do the S&P or the Russell. Or is it more interest rate risk? Then do ARC. So it really depends what you're trying to hedge against, and everyone's got to have their own idea about that. I mean, Oil Guide has been pretty public about his short on Shopify, and he's killed it. He's killed it twice, actually. He shorted it, covered it, made money, went back up, shorted again. And so that's because he really has a view on Shopify. And so if you have a view on a particular stock you want to be short, that's fine. But I'm not going to get sucked into, well, what stock would you short? It's just not what we do in this room. Thank you for the question. Seth, did you have a question? Seth?
Hey, George, as always, great room. One question and one comment, perhaps. I think you asked, you were reflecting, perhaps, which is an area of the market which might be exciting at this point in time. I think to paraphrase you, I think there's, if you read Seth Klarman's letter, Seth Klarman, who you don't know, some people might not know, he's the guy who runs Baupost, which is one of the biggest distressed investor firms in the world. I mean, his view is, obviously he's as scared as us, right, in terms of where the market is heading. But they are sitting on 40-50% cash at the moment, right? Because they see this as massive opportunity as volatility picks up to buy some assets at cheap. Just to give you some perspective, right? Baupost invested at the height of Lehman crisis about $10 billion and made annualized return of 8% for the last 12-15 years, right? So Seth Klarman obviously knows what he's doing. So that there will be opportunities like that in the market, I hope, coming up in the next sort of 6 to 12 months. I think the question I have, George, perhaps is we talked about peak inflation in the last couple of weeks. Do you think we are close to peak inflation, or is it just rhetoric?
So, good question. Let me say two things. First thing is, Seth Klarman is a personal friend of mine. I've known Seth for 35 years, so I know Seth very well. Seth is very cautious. Been cautious for a long while. It's interesting though. You look at who the smartest guys on the board are, whether it's someone like Howard Marks or Seth Klarman or Warren Buffett. They all have a lot of cash. Watch what they do, not what they say. In some cases, they also say it. So the smartest guys in the room have cash, and you have charlatans like David Portnoy of Barstool Sports. I'm going to name names: Jim Cramer, Kathy Wood. I could go down the list. Come on in, come on in. They're like carnival barkers. So, if we're going to the schoolyard playing pickup basketball, and you got Kathy Woods, Jim Cramer, and David Portnoy on one side, and Howard Marks, Seth Klarman, and Warren Buffett on the other side, who are you going to bet with? Okay, so that's my answer to that. And what was the question? I'm sorry.
Yeah, just the idea on peak inflation. Do you really think?
Yeah, I don't know, and I don't think it's the right question. I really don't think it's the right question, because people say, well, used car prices are rolling over, and it was 8.2%, and it's going to be 8.0%, and to me, it's not whether it's peak inflation. Actually, I think inflation could go higher, believe it or not. So I'll answer the question too. Is A, I'm not sure it's the peak. I mean, it could go higher, because if Mike Rothman is right, and oil is heading to 150, and food prices keep going up, and oh, by the way, housing prices are still accelerating. You just go down the list of what goes into the CPI. It's all going up still. So one, I'm not sure that it's peak inflation. In fact, I think it's going higher. But even if I said, okay, it's the peak. So let's say you say, oh, okay, George, good. You told me it's the peak. But then I say, not so fast. Let's say I told you inflation was still going to be 6.5% by December. Still be a huge problem. So whether it's the peak is not the right question. The question is, how sustainable is it? And if inflation stays elevated 6.5% the next 9 months, it's still a problem. So it still speaks to a negative liquidity environment. So I don't think you're going to get really much respite for the equity market on the inflation picture. I think another way of looking at it is, imagine when you keep a beach ball under the water for a long period of time, and then you let go. The natural tendency is for it to rise. It goes back up to the surface. Well, that's the way I look at interest rates. They're now just going back to where they should have been all along. How inflation is going to go down to 4%, which I think the Fed believes it's going to by the end of the year, I don't understand. But let's say it did. You want to tell me a 2.9% 10-year long bond's a good deal? I don't think so. So it's not an academic discussion about, are we having a recession? Well, no, what's more interesting is, are we having an earnings recession? It's not, has inflation peaked? No, it's, will inflation come down? And I don't expect any respite from the bond market. That's the way I'd answer that question. Does that answer your question, Seth?
Yeah, I think so. Thank you.
Thank you. Okay. KFAB, you had something you want to chime in, KFAB?
Yeah, I wrote something about this week. I think that the two aspects that really make the inflation forecasting business treacherous right now are how stupid politicians get. And I think we underestimate how bad that can get at times. So whether it's the global financial war that's now commenced, and potential cascading supply chain impacts. I mean, I don't think most people saw China locking down the way they have a month and a half ago. So who knows what's coming in the pipeline as far as additional supply chain damage that could be incurred. And then, incentivizing consumption, price controls. I mean, there's a lot of things here as supply chain issues continue to impact, and we get this potential global famine and potential huge migration of people out of the Middle East and other impacted areas at Europe's doorstep. I mean, who knows what politicians are going to drag out in stupid ideas that could compound this stuff on an intermediate term basis. So even if you're bearish on the economy, normally the economy beginning to contract is deflationary or disinflationary at least. bringing inflation rate down. I just think that given how compressed things are globally, politically and culturally, societal acrimony, all of these things, it's like a tinderbox. And politicians can just go completely berserk, like we're seeing in Japan right now. I mean, that's why I keep saying, look at Japan.
So KFAB, I couldn't agree with you more. Excellent. And KFAB is a must follow for you. Those who don't know him, he's very modest and humble, but I'm always challenged and by his thought provoking insights. And KFAB, you're totally right. Right now people can sit here and say, well, inflation's peaking. It's not peaking based on what you're looking at right now. But with respect to my Canadian friends, as your great hockey god Wayne Gretzky would say, go to where the puck is going, not where the puck is. So, 6 months from now, if inflation is much higher because oil's at 150 or, natural gas is at 12 or wheat's at whatever, 40, and people say, well, our forecast would have been all right, except for the fact that oil prices went up. Who knew? Who could have possibly expected that? So, again, there are a lot of known unknowns and unknown unknowns. The only thing that I know is that I don't know. And I urge everyone to approach markets with a similar degree of humility and doubt. All right, we're going to kind of wrap this up shortly. But before we do that, a few other people on the stage here. Again, I'm going to implore you. We've I think raised $2,500 since in this room. Christine, we thank you for your $2,000 match. I just ask you to please, when you make the contribution, please do it through our link to World Central Kitchen so that our effort gets the credit for it. I'm gonna address Phil, but Phil, before you come up, I just want to warn you, not a threat, just a warning. We normally don't allow crypto-oriented people speaking in this room, simply because we find crypto to be a very polarizing subject, and those who like it, and those who hate it. And it's rare that we get, no, you're not going to win any hearts and minds on either side. So if your question is something about other than crypto, you're welcome to speak. But if it's crypto related, we're not going to allow it. So Phil, the floor is yours.
Thank you, George. No, that was not my question at all. And thanks for addressing that. It is pretty polarizing. There's a lot of nuance in this world. So last thing I want to do is make the room angry. So I appreciate you coming up, and I love all the rooms that you do. And my question, kind of a two-part question. I heard that the Fed was actually removing housing and mortgage-backed securities off their balance sheet, and so I'm assuming that would cause maybe the price of housing and just like rent to possibly go down, or at least people's value in their homes would decrease. So I don't know what your thoughts on that are. And then secondarily, I do agree that we could see higher inflation, but also interest rates would continue to go up, whether or not the Fed actually does raise 50 basis points per FOMC meeting. That is a question to ask and just kind of be on the lookout for as time goes on. But I guess with the U.S. debt being indexed to SOFR now instead of LIBOR, how do you think the Fed do you think the Fed could actually pull off raising those interest rates because of that new fact that has been officially rolled out as of this year? So I'll just give you.
Phil, hold on, Phil. You make a lot of interesting points, but I'm not sure I understand. What exactly is the question, Phil? I'm not sure what your question is.
Yeah, sorry. So the first one is do you think housing is actually going to continue to go down because the Fed removed MBSs off their balance sheet? And then second question, do you think the Fed can get away with raising rates with debt being indexed to SOFR?
KFAB, do you want to take a shot at that? KFAB?
Can I perhaps take a shot at it as well?
Yeah, so wait, hold on. Well, God, you go first and then KFAB. I'm kind of getting here. Well, God, and then KFAB.
Thank you. Sorry, I'm just stepping out of the gym. The MBS market is not new. The MBS market was obviously created largely, the impact obviously from a headline perspective was felt after 2008 when the housing market collapsed. And when the Fed purchases things to stabilize markets, they end up selling these things to some of the largest asset managers. Like I know the Pacific Investment Management Company in Newport Beach, PIMCO as you would call it here, Bill Gross's old firm. They're huge buyers of the MBS market. And so, it's just paper shuffling from one to the other. And the Fed literally was hand-holding the housing market like they were with banks and toxic assets.
So I wouldn't use that as any indication of housing. Housing is an issue where you look at a K-shaped recovery. Year 2008, which was V-shaped, everything, good, bad, rich, poor, entrepreneur, employed, everything went down like a V, and everything went up like a V in a sense. This COVID has created a K-shaped recovery. We all went down with the left side of the K. Those at the top continue to feel fine. Those at the bottom couldn't feel worse. And so when you have lots of money, cheap, and to George's point, we have cheap money for this long, right? That K, obviously you get lots of participants there because you've got not only that real estate prices have gone up, equity prices have gone up, and now look at a lot of people already in the K, what's happening with their income. Like if you're in tech, you're getting $100,000 offers to cross the street, right? And so the problem with housing is there's just not enough supply to meet the demand of the K. Now, of course, you're very, very early. Come later in the cycle, obviously, if rates go up and lots of people at the top end of the K are new to money, they don't know how to balance the balance sheets and they're over levered, you'll probably see a slowdown. But to be honest, in really, really nice parts of the world, I live in Vancouver, you see prices, for example, sales slow, but you don't see prices necessarily plummet. And this is probably a lot to do with, again, a finite supply of very nice places that people want to live. Where, if you're in Shanghai right now, think about it, right? You're locked into an apartment that costs about $2 to $3 million US. I mean, if they could tell you what $2 to $3 million could buy you in Texas, I mean, these people would be leaving Shanghai tomorrow, and there's way more people there than anywhere else. So, George, I just will pass it back to you with just some of those comments, or to KFAB.
KFAB over to KFAB, you're.
Yeah, I think if you look at what's going on in markets relative to the housing stocks, mortgage REITs like Redwood, which is a jumbo kind of private label mortgage originator, so not Fannie Freddie type stuff. Bank index, pretty much at or starting to break the February lows. I think that the stock market is screaming or beginning to that's probably rolling over, and that's just intuitive relative to what's going on with rates and the refi index and various other things. I don't really have any expertise or insight on the SOFR question.
Thanks for that. All right, we're going to wrap this room up shortly again. This has been a great room. We start off with Michael Howell, and please give generously to World Central Kitchen. The link is up in the nest. We've raised over $3,000 today. In addition, Christine pledged to match at $2,000. So it's $5,000 for the room. Christine, again, I'd ask you to please use the link that we have provided rather than the one that you provided on Twitter, just because we want to make sure that our efforts get credit. If you give on the link that you posted, we won't get credit. So please use the link that we've posted. That's awesome. Thank all of you. So I want to go to Gilberto, and then we got 2 or 3 more, and then we're going to call it a day. Gilberto, my friend, what's up?
My friend George, I'm very pleased to be here and to be listening to all of you. What I want to contribute to the room is the bullish case you were asking for. Where is the bullish case in all this? And I have good news for you. But first of all, we need to acknowledge that the bullish case is after a brief and hard recession where rates are going to go much higher than what people think. And this is because you first have to complete the liquidity crunch cycle of what Michael Howell has been talking to us and preaching to us and teaching us to see through the lines of the day-to-day price action. This why I say with this level of confidence that the bullish case is just after that brief recession is because what I've been sharing with this room from months ago, my live through this same scenario in Dominican Republic in the 2003-2004. We had the same type of situation with high inflation because of banking system debt crisis, and monetary policy grew astonishingly. Credit certificates were paying like 50% in the peak of the crisis, just to take money out of the other investment and being thrown into the central bank that was paying that higher credit certificates rates. And after regime change, came some elections, 2004, the losing party went out of power. We had a new president, and the national sentiment changed. And what happened was that after the change in the regime of the political cycle, we had a new easing phased on the monetary policy, and we grew steadily above 5% for a whole decade. Some years 8%, some years 7%. You can search for it. It's called the Dominican economic miracle. It was not a miracle. The same way there is no geniuses, there's just cycles. The same way it's going to happen. And in this regard, my only advice is this is a bear market. The hardest part is to stay out, to stay in cash. Is the same as say stay in dollars. I said in the past room I participate. I think the right move is to go to dollars for EM participants, emerging market participants. The same thing I think is the right choice for most of American participants. Go dollars, go gold, go gold. That means go cash because the bear market is going to affect all type of investments. And with this in mind, what I think we just need patience. We need patience. We need to wait for the cycle to end and don't fight the Fed. That's all I have to say.
Gilberto, my friend, I love listening to you talk because it's just you speak with such an earnest, sincere wisdom and years of experience. And I also enjoy the fact that you speak from the Dominican Republic, so it's a slightly different look on the world and will the experience that comes from having seen some real macroeconomic volatility where you come from. So it's really helpful. All right, we're getting towards the tail ends here. Is there anyone on stage who wants to ask a question? Again, we've raised over $3,500 with Christine's matching plans is $5,500. I'm really excited about the progress we're making. Our goal is $200,000. On Thursday, John Roque and I will be co-hosting the keynote speech at the CMT conference on Thursday afternoon at 3:30. That'll be available to everyone through our YouTube channel. It will be free. I'm expecting that's also going to be a big fundraising occasion for us. You know, the folks at World Central Kitchen are doing God's work. They're literally taking our life in their hands. They got bombed on. Other organizations won't go in there because they're getting bombed on. So, you know, everyone in this room is extremely fortunate. And I ask everyone to pay forward. We do these rooms. Again, I want to call out Andrew and Carol and RJ and Jack. Wouldn't be possible without their help. They do this all pro bono because it's their way of giving back. I do it. It's my way of giving back. And I ask you guys to give back and pay forward. With that, I don't know if anybody else on stage has any more questions. Anyone raise their hand? Otherwise, I think we're going to call this a day. We're almost on 3 hours. These are really interesting times in markets. Our next session is going to be on Monday at 4 p.m. Don't miss it. Chris Verone, head of technical research and strategy at Strategas, will be speaking to us. I have an endless backlog of top-notch institutional speakers lined up for you. We've had about 25 of these rooms so far. I have another 125 in the wings. Yes, you heard that right, 125. And the list keeps getting longer. We've really created something very special here, and it's because of you. And I'm not saying this to just blow smoke up your backside. The reason people like Michael Kantrowitz come in this room, he didn't say this, but I'm guessing this is true, is because there are smart people in this room. He enjoys the dialogue. He learns from people in here. There are a lot of intelligent people in here. And, you know, Stan Weinstein, take him as an example. You know, I had to When I first asked him to come in this room, he's giving me a hard time. Oh, Jack Dorsey, Twitter, left-wing commie, blah, blah, blah. What is Twitter? Who needs this? Yada, yada. I finally convinced him to come into the room. He was swearing at me. He says, I'm only going to give you an hour. Well, he stayed in for 2.5 hours. And not only that, he got a lot of business out of being in this room. He enjoyed himself. We learned a lot. He got more business. It's all good. And again, we've created something very special here. It's not me. Yeah, okay, I have the contacts. That's fine. But the reason people like, Stan Weinstein and Michael Cantor's coming in this room is because of all the smart folks in this room like K-Fab and Gilberto and Oil God, and I could go on and on and on. So I want to thank all of you. This has been a fabulous room. Michael, Howell, I think at the top of the hour, just remember, be safe, be defensive. And I'll talk to you guys on Monday at 4 p.m. Take care, everybody. Bye-bye.